risk. But I mean, I have like a dollar amount P&L, but these things happen so fast that I don't even have the chance to like say, all right, I'm going to risk, 1% of my equity and I'm going to size it according to this. For me, it's like I'm either early or I'm not, or I have an edge or I'm not, or I don't rather. But yeah, there's like a rough P&L thing that I have in my head where if I hit that, I just got to get out because I've seen too many times I get to.
Chat with Traders is brought to you by Trade the Pool. Becoming a funded trader means trading with a firm's money instead of your own. At Trade the Pool, you first complete an evaluation by hitting profit targets while managing risk. Once you pass, you get access to up to $260,000 of buying power. You keep up to 80% of your profits while the firm covers the risk. It's the perfect way to trade big without risking your own funds. Are you ready to become a funded trader? Join Trade the Pool.
Chat with Traders is also brought to you by Tasty Trade. Ditch those rookie trading apps. Get Tasty Trade, the platform for serious traders. Chart with 300 plus indicators, know your profit odds, and move fast. Trade stocks, options, futures, and more, all in one account. See why serious traders choose Tasty Trade. Visit tastytrade.com. Tasty Trade Inc. is a registered broker-dealer and FINRA, NFA, and SIPC member. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
Sitting at the desk, I don't remember the ticker, but the Wall Street Journal broke a story about XYZ being in talks to be bought. Boom, boom, boom. I type the ticker in and boom, boom, boom. I hit the hotkey. And whether it's in trading or anything else in your life, sometimes you react really quick. And then 1 second later, you go, oh, shit. Like, what did I just do? So I get out of the trade as fast as I get into it. And I look up at my P&L and I go, oh, my God. Like, I made more money than I made as an analyst in about like 20 seconds.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Chat with Traders is on episode 293. Hey traders, how's it going? Tessa here. And this just might be our last episode for 2024. We want to take this special opportunity to thank you all for regularly tuning in to Chat with Traders, and we deeply appreciate you. Please share the podcast with as many people as you can. If you feel that this podcast can add value in any way to someone, thank you so much. As we reflect on 2024, as we near the close of it, whether you've been profitable in the markets this year, or perhaps more importantly, gained wisdom through the challenges, the setbacks, and the breakthroughs, do you agree that we've got to have grown stronger? It may not feel like it at times. I deeply know this because I'm going through it, but each stumble taught resilience, each loss offered lessons, and our persistent belief in ourselves is critical and will lay the groundwork for a promising 2025. I really, truly believe that. Well, we also want to take this opportunity to wish you and yours a wonderful holiday season. Merry Christmas for those who will be celebrating. Happy holidays, happy year end, happy new year, happy everything. Now let's get to our interview. Today, you'll be listening to a wonderful chat that my co-host Ian Cox had with our new guest. His name is Rick Bandazian Jr. I feel like Rick is, just a cool guy. And he's also a dear listener of the podcast, which we really appreciate. So Rick is a seasoned trader with over 15 years of experience in event-driven and merger arbitrage strategies, or merger arb as they would call it. He transitioned from working as a banking analyst at JP Morgan and First New York Securities to then establishing himself as an independent trader trading for a living. Rick has deep expertise in anticipating market moves based on nuanced corporate actions, and he has a very methodical approach to understanding these types of catalysts, such as the merger arb type of events. I could be wrong, but I'm guessing that he was able to leverage some of these skills that could be one of the edges that he gained as an analyst as he crossed over to trading, even though the two roles are completely different. I mean, I've tried to trade these types of events, and let me say that it would be like gambling on my side if I had to trade against other traders like Rick, because he's equipped with real strategies and methods with edge for these kinds of very specific plays that he has perfected over time. He's honed his craft, and we will get to gain a lot of interesting insights as Ian dives into Rick's thoughts, process, and setups. Well, I'm going to leave this fun, entertaining, yet also informative and educational chat for you to enjoy. So without further ado, ladies and gentlemen, we're so pleased to introduce Rick Bandazian Jr., originally from the New Jersey, New York area.
Well, Rick, I'd like to welcome you to Chat with Traders.
Thanks for having me on. I appreciate it. Yeah, I'm a longtime listener, and it's always a great forum to hear different perspectives and different people's process, which is always really interesting for me. So I appreciate you having me on.
Yeah. Well, tell us a little bit about your kind of where are you now? Where did you grow up? Early interests.
Sure. You probably never heard this one before, but right now I'm in South Charlotte, and I'm in my office on the second floor of an old firehouse that I own. And my tenant has a brewery downstairs on the ground level. So if we hear anybody getting rowdy, just bear with me. But yeah, so I live in South Charlotte. I've been down here for about 6 or 7 years. Married, I got a couple kids. We moved down here from North Jersey, Bergen County, New Jersey, which is just outside of Manhattan. So I guess I consider myself like a New Jersey, New Yorker, and I stayed local for school. I went to Fordham University, which is in the Bronx, New York, and I played ice hockey in high school. I was an ice hockey player at Fordham, and I was a finance major. And people always ask me why was I a finance major, and I don't really have a great answer for that. I guess I just didn't know what I wanted to do, and knew that I wanted to make money, and I figured it was just probably a pretty good idea to do that living pretty near Manhattan. There'd be job opportunities or whatever. So
yeah. How did you first become interested in the markets?
I didn't have any direct family in the business, and I never traded. I know a lot of your guests, they traded when they were really young, or they traded in high school. That really wasn't me. So I guess, maybe it was some of the coursework at Fordham. And, once you hit your junior year, you got to start sniffing around and trying to figure out what you want to do. So being an investment banker was like the sexy job at the time. And, I don't know how much appetite, I guess there's still appetite for doing that, but I kind of muscled my way into an investment banking gig. All the bulge bracket firms, they came to Fordham for various jobs, but they didn't come at the time for investment banking jobs. And I, just old school, pounded the phones and sent resumes out. This is like 2000. So I landed at JP Morgan in their investment banking group. I was in the syndicated finance department. And for people who don't know what that is, we basically, it's a sell side gig, and we were raising capital for corporates and LBO firms. And it was mostly a boring job, but every now and again we would do financing for an LBO, which was pretty exciting because I could see like all the work that I did, that 90, 100-hour weeks, the deal would hit the tape, right? And there'd be excitement and conference calls, and the stock would gap up and all that stuff. And for those that are not familiar with the investment banking thing, you get hired as an analyst, you do 2 years in the same group. If they like you and you survive, you get invited back for a third year. Well, we had some crossover work with the equity capital markets group. And I made like an unusual push into that group after a year. And that was closer to the markets, because that group also raised capital for corporates, but they were raising capital via secondary offerings and convertibles. And that was even more exciting for me because everything I did was on the tape, right? There'd be a convert, and the stock would get hit, and it was like, hey, cool, I worked on that. But after doing that for about 2 years, I realized that life wasn't really for me. It wasn't the hard work. It was just, I don't know, you got to play politics, and when you get hired as an analyst, you're going to get paid between X and Y salary and X and Y bonus. And even if you did a 2x or 3x better job than the guy sitting next to you, you were just going to get paid the upper end of that range. So I wanted more of like an immediate report card, so to speak.
Mhm.
So I was really learning about what the buy side was versus the sell side, because when you're a kid and you're putting your head down for 100 hours a week, you really don't have time to do a lot of that stuff. So, I decided to pass on that third year gig, and I wanted to make my own luck. So I basically got hired away to a prop trading firm. You've probably heard of it, First New York Securities. And a ton of talent came out of that firm and still does. And I was hired not as a trader, because that's the typical path there. You get hired as a trader, but you go through, at the time they had a really incredible trading program. I'm sure they probably still do. And you got hired as a clerk, and you would clerk for somebody for like a year or 18 months or whatever. And when you were ready, or when the firm felt that you were ready, you'd go out on your own. They'd give you, X million, and they'd say, go ahead, fly free, do your thing. And typically those people would, they would trade pretty similar to the person that they clerk for, right? Because that's what they're used to seeing and following. So anyway, but I'm an analyst at this point, and the PM that I work for traded what's called event driven. And I didn't even know what the hell that was at the time. Obviously I do now. And it's exactly what it sounds like. You're trading around some sort of an event, a catalyst. It could be typically like a corporate action. It could be a merger, spin-off, split-off, Dutch tender, anything with an event, an analyst day, could even be an earnings report. And the trades would be, call it short to intermediate term time frame. And that's really what I wanted, because it was, you trade, you get an immediate report card on what you're doing. So that's what I did for a few years. I would generate ideas, and the PM that hired me knew that I could, run models and comps and talk to CFOs and, model cash flow statements and all that stuff, and, do idea dinners and all that, and all that fun stuff. So, I did that for a few years. We ended up spinning out into a long short equity hedge fund, doing the same thing. I had a couple of guys working under me. I was like, still in an analyst role, not a trader. A couple of years into that, I got hired away.
Just curious. So as an analyst there, like what did you do? Like, how did you advise the traders, or what did the traders look to you for kinds of information and kinds of analysis?
As an analyst, I guess whether it's event driven or fundamental or whatever, you're just constantly digging and digging and digging and talking to as many people as you can for ideas, and looking at the calendar and, hey, your buddy's long XYZ. Well, why are they long? Okay, that's kind of interesting. So you're like an idea factory is really what you are. You're really trying to come up with ideas, and then you bring them to your portfolio manager, your trader, whether it's a small firm or a large firm, and then they sort of run it through the gamut. Okay, that's interesting. Why? What's the setup? What's the timing? What are the events on the calendar? So that's pretty much what we would do. And, it was long and short, but we stayed primarily in equity land. We did some fixed income and, capital structure arbitrage, but typically it was just a directional equity bet. Just to circle back here. So I did that for a few years. Then I was hired away to one of the biggest Canadian banks, to help run their event-driven and merger arb prop book, and did that for a few years. And now we're in 2008.
Just before the crash. That's great timing.
Yeah.
So just to be clear, so you went, when you went to the Canadian firm, are you now transitioning from an analyst role into trading, or were you doing the same?
No, so I was doing the same, but I was, at some elevated role or whatever. So I wasn't quite co-portfolio manager, but I was kind of the right-hand man to a guy that had done merger arb for a very, very long time. And this is probably about 05, 06. So we had, a really good run. We had a good run for about 2 to 3 years until 2008 came. And then obviously 2008 blew everybody up. It's a really funny story in hindsight. At the time, it wasn't. But if I've never been let go of a job in my life. And, we were making money, and the bank was unlike most other banks and most other firms. Like, there were just holes in balance sheets everywhere. So we had certain, we had a certain amount of capital that we were using to run our strategy. And they just said, look, sorry, game's over. And they said, we need that capital for elsewhere. And like I said, I'd never been let go of a job in my life. And again, funny now, not funny at the time. They bring me in a room and they tell me what happened, and they tell me how, they're letting the whole group go. And I said, all right, great. And I said, when? And the guy goes, right now. I said, oh, great. That's terrific timing. I'm having my first kid in about 10 days from now.
Oh, God.
And anybody who has a job where they can like press buttons and trade, that can do damage if they go rogue. I mean, I would never dream of doing this, but it's kind of funny. You go back to your desk, your computer's gone, your keyboard's gone. So anyway, our whole group, we go out to the bar, of course, and commiserate. And I wake up the next day with a really bad hangover. And I end up calling I'm not going to name him, but I called one of the founding members of First New York. I had really good rapport with. I told him what happened, and he says, look, there's an event-driven guy here that wants an analyst, and I'm also going to give you a pad. Come on Monday. I was like, holy shit, that's great. So I'm out of a job for, I didn't know how long, and then I'm really out of a job for like 48 hours, right? Mm-hmm. So now I'm in this, now I'm like a trader, right? So I'm still doing the analyst work, but now I get a pad at First New York.
So what does that mean? What does that mean? You get a pad?
They basically give you capital to trade. That's what that means. So, so again, I get invited back, and I have this pseudo role where I'm an analyst, but I get a pad. It's X $1 million pad, and they say go, because they know I've done well for them, and I had a good track record in my career just doing event driven. So this is like the whole story of my transition from analyst to trader. And I told this story to somebody else the other day. Analysts think they're really smart, right? Mm-hmm. And the analyst is always very aligned with the portfolio manager. Of course, they have the same goals. But I didn't realize at the time, even though I had worked hand in hand with all my PMs as an analyst, man, it is a different job. It's a completely different job, because you're an idea guy as an analyst, but the trader or the PM has to think about all these other things that an analyst really doesn't have to think about. Position size, the setup. And we can get into what the setup means, in a little bit. I think it's pretty interesting. I think it's actually a very interesting, important part of, probably the most important part of trading. And so now I'm sitting in the seat, and I'm thinking I'm really smart, and there's nothing to do because it's 08. So there's no corporate actions, right? There's no mergers. There's very few. I could probably count on one hand the amount of corporate action or event-driven situations that are out there, but because there's so few, they're crowded and they're difficult to make money.
So you weren't tempted to try to trade other strategies while you're waiting, either for the firm, or maybe did you have your own personal account that you were trading?
I can't even remember. I probably had a PA at the time, but to your point, that's exactly what I did. I said to myself, all right, I'm a month into this thing. I'm starting to look over my shoulder now, right? Because I'm not making any money. I'm not losing money, but I'm just like up 1 unit, down 1 unit, up 1 unit, down 1 unit. I was working on a couple things, sort of like side gigs, side projects, like momentum trading and some fundamental stuff. So to your point, you're right. So now I've got like 3 or 4 different strategies I'm running across the pad that I was given. But same thing, up 1, down 1, up 1, down 1 with every single strategy. I'm still doing the analyst thing. And this was like the pivotal moment that kind of set me on the stage for probably the next 15 years up until today. I'm sitting at the desk. I don't remember the ticker, but the Wall Street Journal broke a story about XYZ being in talks to be bought. Boom, boom, boom. I type the ticker in, and boom, boom, boom. I hit the hotkey. And whether it's in trading or anything else in your life, sometimes you react really quick. And you know what? I understand now why I got in and out of it. At the time, I don't know. I think I probably just blacked out. I obviously I knew the stock was going to go up, right? XYZ and talks to be bought. And I just reacted. So that happens. And I'm like, I get a little bit of breathing room now, right? I'm like, all right, I don't have to look over my shoulder. I go back to the 3 or 4 strategies I'm running. Again, up, one, down, one, up, one, down, one. And then like, I don't know, maybe a week or 2 later, same thing. Now I'm kind of prepared for it. I'm sitting in front of the screen and I'm kind of waiting like a sniper, waiting for something to come. Meanwhile, I'm working on all my other stuff. And then same thing, boom, 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 in and out. And again, I don't remember what that ticker was either, but strangely, the P&L was the same. I'll never forget the P&L was the same. And right there, I said, I'm just going to do this. What am I wasting my time doing all this other stuff for? And that kind of set the stage for what I do now. I mean, I don't trade that exact way now because a lot has changed. Technology's changed. These guys have black box API, co-locate front running stuff on all these, headlines that come across the tape. Now,
so you're saying the market was less efficient back then?
It was much less efficient. Now you still, I've always been very, very diligent about case studying every trade that I do, especially when it comes to news. I categorize things, size, time of day, thoughts at that moment. Was it a fast trade? Was it an idea trade? But back then, again, this is late 2000s. There were no black box machines on the headlines. Now I wouldn't even try now because you just get whipped. But you had, sounds fast, but you had about 2 to 3 seconds to react to stuff on the tape back then because they weren't black boxed like they are now. Mm-hmm. And that lasted a while. And again, there's a lot of nuance to what I do now, and we can get into all that with merger arb and event driven still, but generally that's kind of the same thing that I'm doing now, except I'm not trading like those headlines. Just to wrap up the history here. So I do that at First New York. I spin out into like a First New York related family office. I do that for a couple of years. And then I realize, I don't need 25 or $50 to do what I do because I'm in and out of stuff so fast. I don't need a huge portfolio. In fact, I typically don't even run positions overnight. And again, we can talk about why I'm not really a believer in doing that, or anyway, it's not my style. And then about 10 years ago, I just decided to go out on my own and keep it all, so to speak.
So when you say you're going on your own and keep it all, meaning you're trading just your own account, or what does that mean?
Exactly. Yeah. So, when you get hired away at a prop trading firm, they give you the capital and then you have some sort of a payout. Again, I think some of these guys, they either don't want to run their own money because they don't have the confidence to do it, or somebody's just not worth $50 million or $100 million and they want to take firm's capital. And then the trade-off to that is you have to give the firm X% P&L. But for what I do, I can run my business on just a couple of bucks. Like I don't need that big capital that I would need to go to like a First New York or whatever, because I'm in and out fast.
Chat with Traders is brought to you by Tasty Trade. Tired of trading on rookie apps? Then get the platform for serious trading. Tasty Trade. Tasty Trade gives you the tools to trade your way. Chart your heart out with over 300 indicators. Know your odds with probability of profit. And move fast with Quick Roll. Trade what you want and trade it your way. Stocks, options, futures, and more. All in one account on one platform. No wonder why serious traders choose Tasty Trade. Visit tastytrade.com and see for yourself. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Hey, I got a great update from Trade the Pool. Now it's even easier to get funded. As you know, Trade the Pool built a unique program to evaluate stock traders like yourself and provide you with the company's funds to trade with. It's real shares, and you no longer need to worry about the PDT rule. But that's not all. Trade the Pool has introduced a new tier with $20,000 in buying power, making it easier to pass the evaluation and speeding up the process of getting funded much faster. You don't want to miss this opportunity.
This episode is brought to you by Google Gemini. With the Gemini app, you can talk live and have a real-time conversation with an AI assistant. It's great for all kinds of things, like if you want to practice for an upcoming interview, ask for advice on things to do in a new city. By the way, this script was actually read by Gemini. Download the Gemini app for iOS and Android today. Must be 18 plus to use Gemini Live.
But how often do these trades actually show up? How long do you typically have to wait before something pops up on the screen?
That's another really good question, because I'm in this this 2-week lull that we briefly talked, like a typical drawdown, like a lot of traders do, but like a drawdown for me is going like the last 2 weeks where there's just not a lot to do. So I could go 3 days without trading a single share in anything. And, I just have to be ready for these things to come. So, maybe there's a trade every day, of course, right? Sometimes you realize in hindsight what the trade was.
When you say there's a trade every day, but is that directly tied to your strategy of event-driven arbitrage type activity, or?
Yeah, there's always, so just to take a step back real quick, what I do now is kind of in the same universe of what I explained before, but, merger arb is deals announced, and, there's a spread usually relative to the deal price because of various factors or whatever. So at any one moment, there's 75 to 100 announced deals, and I keep track of every single one of them. And I know, who the buyer is, what the price is, what antitrust approvals are needed, when the company said they're going to close the deal, where they're incorporated. I mean, there's so much nuance to that. And then secondarily, I also keep track of all of the, these are really considered more event-driven, stuff that hasn't come to fruition yet. So a good example of that would be the Wall Street Journal, like I said, breaking a story about XYZ being in talks by private equity. Naturally, that stock is going to gap higher, right, from that time period. But sometimes you get a week, 2 weeks, 2 months, even a couple of quarters before a deal is actually announced. So in the meantime, that stock is gyrating around based on expectations and based on, what the fair value is, based on where comps are going. And so there's all this new news coming out on every merger arb deal that's announced, and also all the event-driven deals that are announced. So what I do now is I'm like very, very up to speed on all of these situations. I mean, there's probably a couple hundred of them, but there's probably 30 or 40 that I'm like really dialed into. And as news comes out, I'm able to react because I'm already up to speed, right? Mm-hmm. Can I give you
what does that mean? What does that mean to be up to speed? Or do you look at the fundamental analysis of the company that's being bought and their offer price and figure out, okay, well, based on this, it should have at least a 10, 20, 30% run at a minimum. And do you shoot for that kind of higher end range, or are you happy with just scalping a few percentage points here and there in just seconds?
I could probably explain it better if I give you an example. So there's no point in me naming tickers, but Reuters, for example, broke a story on XYZ a couple of weeks ago about them being in talks with private equity, right? So the stock gap's higher, and it's been a couple of weeks. The stock's starting to trail off a little bit. I think it's too difficult to take a position in that stock now. I mean, I have a rough idea. It's going to go down, 8 to 10%. If the new headline that comes out says the talks are off, for example, because there's no edge in that. Everyone has all the information. Everybody's already processed all that information. But I also know that that stock is probably going to go down about 8 or 10% because I'm following it, because I watch where it came from. I index everything relative to the comps, right? So if the comps are up a lot and this thing is starting to fade off, maybe it's actually trading near fair value because you've had that drift higher with all the other comps, if that makes any sense. So if I was an analyst, maybe I'd actually recommend that to a PM, like, hey, there's only 3 or 4 or 5% downside in this, and we don't know what the upside is because the deal could be at a 20 or 30% premium to where it is now. that's more of a PM bet. But again, because I'm so up to speed on all the situations, I know that if XYZ gets some antitrust approval, I have an idea roughly where it's gonna gap up, right? If that antitrust approval is not expected. But I also, I know where the deal price is. I know the other antitrust approvals that are coming. Today, in fact, there was a company that received antitrust approval in the EU, some pharma deal that I'm following, and the stock gapped higher on that headline. I did not short it because it didn't get high enough, but it did gap higher. But I also knew that that was already expected because, I don't know, Wall Street Journal or Bloomberg ran a story 2 weeks ago that says the EU approval's coming. So what I'll do is, if that got too high, I might fade that stock because I already knew that that was already coming. And I also know that they still need Hart-Scott-Rodino in the United States. That's the big one that they need. Just as an example, if that makes any sense.
Mm-hmm. Mm-hmm.
So, but if you're not up to speed on these situations, maybe you chase that stock higher because all you see is approval. Like, what does that mean? Approval's positive, but how positive? And what's left? And what's needed?
I see. So you're doing a lot of research, right, before these news events are finally released and confirmed, and you have a very good idea on potential upside caveats because you're dialed into the nuances of each deal.
Exactly. That's exactly right. Another good example would be if some tier 2 activists bid for some dog shit REIT company that's $1 billion market cap. Let's just say on Monday they raised the bid by $1, or they raised the bid from 14 to 15. I already know that first of all, I know that tier 2 activist firm is a lousy firm that doesn't want to buy the stock anyway. And I also know that the company is incorporated in Maryland. And, that's just a small nuance. Like a good event-driven trader knows that Maryland or Pennsylvania incorporation, just as an example, means the company, if they bid $100, the company could say go away, and there's like no shareholder rights, not like when they're incorporated in Delaware. So if somebody takes that stock too high, I'll sell it to them all day because I know when the dust settles, whether it's in 30 seconds or 3 minutes or 30 minutes, everyone's going to go, oh crap, why did I buy that thing? Because now it takes them like 5 minutes, 10 minutes, 20 minutes for them to get up to speed to what I'm already up to speed on. Does that make sense?
Mm-hmm, mm-hmm. So are you looking at also the technicals, or is it strictly you kind of know where your target prices is and you know what prices are considered overbought and you make your trades just based on that?
Yeah. I've looked at charts for like 20, 25 years, and I can't make money looking at charts for the life of me. The only time I'll look at a chart is intraday. I mean, I look at all charts actually, just to kind of see where things are coming from and going. But if I have a chance to buy something because I find a piece of news before everybody else, the most important chart for me is the intraday chart. Like, I want to know if it's moved yet, because by definition, if somebody sends me a chat or I see something in Twitter or whatever, by definition, to me, it's old. And, sometimes I have a time stop in what I do too, because let's just say I find something buried in a news story or buried in a filing. Actually, this happened a couple days ago. I was on a conference call, and I listen to tons of conference calls every day that are either on the event-driven list or the merger arb list. Or sometimes I just listen to the conference calls of like the huge OEX, very thick liquid names, because there's more liquidity, obviously. So Intel's got some event-driven stuff going on with it right now. CEO change. There's some activists there. But on the call, they reiterated their guidance that they gave 2 months ago. And I kind of wasn't looking for that news, but I heard it on the conference, on the webcast, and I quickly pulled up the quote. It hadn't moved yet, so I bought a bunch, thinking, and maybe I could scalp a little bit here, or maybe it just runs because maybe everyone is expecting them to guide down. I wasn't really up to speed on the situation as much as I am on the event-driven merger arb stuff, But what's the downside buying this thing on the offer? Literally hadn't moved. Now, Bloomberg ran that story probably a minute later because somebody at Bloomberg was on the call also. The stock ticked up like a nickel or a dime or something like that. And it didn't go anywhere. So I got out of it. I probably scratched on the trade. The reason I bring that up is because once the world, information's free and it's so ubiquitous, right? I mean, I pay a fortune for my Bloomberg and all this other stuff, but if you're following the right, I don't know, Twitter handles or whatever, you can pretty much have the same information. Like my grandmother has the same information 30 seconds after I do. And my opinion is once it's on the tape and you give it a few seconds or a few minutes, it's priced in, right?
Mm-hmm.
Maybe you get a big shareholder that's off the desk and changes his mind on some piece of news, but it's almost as if I flip an hourglass over. Once a couple of minutes goes by on event-driven news that hits the tape, there's nothing to do. Like now there's no more edge. Does that make sense?
Yeah. So how do you know, like, for event-driven situations that are not directly tied to, say, a buyout offer with a specific price, say all other events, how do you know how much upside the stock would have to, like, say, the CEO changes? I mean, how do you know the stock would necessarily move anyway? And do you have a target, or do you have? Is it based on hunch?
That's a great question because if I'm not up to speed on something, I think it's really hard to trade. I actually saved 2 examples from today, just in case you asked me that question. There was a headline that came out. It says, Apple prepares 3-year modem rollout in a bid to outdo Qualcomm. So obviously negative for Qualcomm, right? Now, a machine sold that instantaneously because there's there's probably like some negative tag there's like a negative tag on Bloomberg. So I'm not going to beat the machines.
Mm-hmm.
I didn't trade that because number one, I'm not up to speed. Qualcomm gapped down maybe 1.5%, 2%, which is pretty big for a mega cap company, right? But I wouldn't dare try to catch that and buy it because, there are guys that understand Qualcomm or Corvo or whatever the other ticker that was in that. They really understand. Like typically what I'll do is I'll go to the Bloomberg and I'll say like, oh, what's the percentage revenue from Corvo from Apple? And let's just say it's 10%. It would take me like an hour to get up to speed versus the guys that know the space cold, like I know event-driven and merger arb. So it's kind of a lesson, whether it's a new trader listening to this, a medium, time trader that's listening to this. You got to figure out where you have an edge, because I'm so out-edged trading something like that for me, like if I tried to catch that stock, Qualcomm or Corvo, and lost money on it, I wouldn't forgive myself all weekend because I'm like, what the hell was I doing trading that stock? I have no edge. So that's the hard part with what I do, because sometimes I have to go days, like I said, days without trading.
Mm-hmm.
But I think Qualcomm actually rebounded, but it's not, I wouldn't even consider it a miss because, again, Qualcomm could have tanked 10% on that if that was some new piece of news that it would have taken me so long to get up to speed on. And maybe somebody really, really knows the situation and is just selling it all day to all the suckers that are like, oh, well, this is probably not a big deal. You see what I'm saying?
Mm-hmm. Yeah. So do you concentrate on a certain basket of stocks or sectors that you get to know really well? And then if you see an event-driven news release on a stock or company that you're not so accustomed to, do you just pretty much ignore it, or do you try to learn from the event and eventually incorporate it into your other group of stocks that you know?
The latter. That's a good question.
The latter.
Yeah. Like, again, if there's a Wall Street Journal headline and a stock gaps up from the machines on a new situation, XYZ in talks with private equity, just for example, I'm not going to chase that because it's going to go up 12%, 8%, 4%. I have no idea. But what that will do is now that'll go on my list. And then I'll start keeping track of it. Now I'll do like a little bit of reading on it. I'll I'll try to understand the setup and what's priced in, what people are expecting. I never pay attention to what analysts say because I think they're worthless. But if there's a couple of analysts out there that make some interesting point, like, oh, they've got all this real estate that's worth some, big percentage of the market cap, I'll kind of note that. But I'll never, every day, there's a buyout story, and then the analyst all opine, and I think it could be taken out for X 20.
But
Yeah.
why is that? You used to be an analyst yourself. Wouldn't you want to trust your fellow analysts' opinions?
That's an excellent question. I'll get back to what I said before. Analysts, I'll get back to that Michael Platt quote from Market Wizards. He says, analysts only think about how smart they are. And it's so true. I don't know. Analysts have a role with getting people up to speed on what a company does. But when it comes to price targets and picking direction, they're not good at it. It's just not what they do. Or they think they can do it, but yeah, I will never ever, because I've watched for 15, 20 years those guys say I think it could be taken out at 25, and then they take out 17, or they say I think it could be taken out 25 and you're shorting it, and then it gets taken out at 40. There's just, and I've put all this into zeros and ones. I wasted my time a couple of years ago doing this, and there's just no statistical significance to what they say. That again, it would have to be like a unique, like them pointing out, like, oh, by the way, there's an FDA thing coming out in 30 days on this biotech deal, for example. That's something for me to note, but I won't trade it. But yeah, to your point, I just try to get up to speed as much as I can. And if not, then it might go on my list to get up to speed for the next headline, for the next approval, or for the next whatever it is. Because then I feel like I have an edge. Because trading, obviously.
Do you have any hard rules to keep you from getting into trouble?
Yeah. Somebody asked me that question. They said, what's your risk management when the trading so fast like this? And we could talk about this macro thing that's sort of a side gig. That's very different because that's more intermediate terms. So you have to think about position sizing and volatility and how much you're going to risk. But I have like a dollar amount P&L, but these things happen so fast that I don't even have the chance to like say, all right, I'm going to risk, 1% of my equity and I'm going to size it according to this. For me, it's like I'm either early or I'm not, or I have an edge or I'm not, or I don't rather. But yeah, there's like a rough P&L thing that I have in my head where if I hit that, I just got to get out, because I've seen too many times I get to that level and I give it like a little bit more room. And then, then it's 3x that. It'll never blow me up, but it won't feel good.
Let's talk about your intermediate strategy that you said you're working on.
Yeah. So I think I just started this thing out of curiosity. Maybe it's because I'm getting older, and maybe because I realized the fast stuff's just getting harder, even though I still think that I have an edge doing that. I don't think a machine or a black box can, not yet anyway, can like get up to speed on the setup, right? And the dynamics of all the stuff that's in my head. Eventually it will happen. But so maybe like 18 months ago, I said, why don't I try to come up with like an intermediate term strategy that's very scalable, maybe something I could do as a, I don't know, side gig for my retirement account, maybe I can go to a place and get capital one day or whatever, but it's in macro. What's interesting is it's like a totally new world for me. I almost feel like I'm 22 years old again, because it's just so different than the way I trade now. Like, I don't have to think about position sizing now. I don't have to think about volatility now. I don't have to think about all these things that you have to do when you're going to trade intermediate term. So what I do is I look at, just kind of inspired by, maybe you had him on as a guest, Jason Shapiro.
Yes.
And he, I listened to a podcast, maybe it was on your podcast, and he just started talking about positioning. and the setup. And I thought about all the things that blew up all the people around me over the course of 15, 20 years. And it was pretty much because they either didn't have good risk management or they didn't really understand the setup. And what I mean by the setup is what's priced in, kind of like what I do with the event driven stuff, right? So I went down that rabbit hole looking at the CFTC positioning data that comes out weekly. And I'm trying to develop this system that looks at that to try to figure out basically where people are offsides. And I look at the equity markets, the treasury markets, FX, metals, energy, grains, like, the softs, all that stuff. And it's a totally different exercise for me because it's like I got to think like a PM, not a trader. How much am I going to risk? What's the volatility? What's the setup? How am I going to get in? Why am I going to get in? When am I going to get out? Why am I going to get out? So that's been, I guess, like an obsession the last 18 months for me. I've really been trying to get that down, but it's very hard because
what is offsides trading? Could you go into detail? Like, what do you look for to find a trade in that?
Yeah. So the thing that Jason said to me, or not to me, he said on your podcast was, it's so obvious, but I don't think a lot of people look at it. He tries to identify if people are very long something or very short something. So you could listen to people talk about what they think about gold, but what matters more? Like, it matters more where people are actually positioned. And it's hard to get that information with stocks, but you can get that information with futures data through the CFTC data that comes out on a weekly basis. So again, I kind of went down this rabbit hole and I started looking at the data, and I created basically it's like a histogram with an oscillator to determine over some look back period how full somebody is long or how short they are, relative to the last look back period. And I'm trying to incorporate that with some technicals and with some discretion. So I'll give you, we can talk about like a quick example. Like if you go back a handful of months, everybody knows about the yen unwind trade, right?
Back last August.
Yeah, exactly. So the yen was just down forever. And if you started looking at the CFTC positioning data, it got to these short levels that we hadn't seen in a very, very long time. So it was almost like it was very wound up, right? So all you needed was, every time there'd be a whiff of intervention, the market would rally and then they would sell it right away. But you knew there was going to be that level. It's like GameStop, like everybody's just short it. It doesn't matter what the fundamentals are. It's a bullshit stock. Like it went to the moon, right? And why is that? Because it was just shorting it, covering it higher, shorting it, covering it higher, shorting it. So the same thing happened to the yen, and the same thing can happen across all of these other markets. And I try to identify setups where people are, just like I said, like I consider them to be offsides long or offsides short. So yes, I've been obsessing about that for the last 18 months. And I feel like I'm back in my first New York days, up 1 unit, down 1 unit, up 1 unit. But a good friend of mine says, yes, you have to stay curious about not only your bread and butter, what you're doing, because if you don't adapt, you'll die, right? You have to always be thinking about, maybe one or two other strategies. In fact, the dude that you had on a couple days ago, what is he run, like 55 strategies or something crazy?
Yeah, exactly.
So he's doing pretty much what the pod shops have figured out about doing, right? You do a bunch of non-correlated stuff and you compound some X return over time. But yeah, that's kind of the gist of the positioning.
So how do you determine when, because these being offsides, being overly long or overly short can last for a very long time. What kind of catalyst do you look for the trigger point that causes a reversal? And then do you wait for that to take a position, or like?
That's a good question, because you're right. Things can stay offsides for a long time. NVIDIA can stay offsides long for, or GameStop can be offsides for some extended period of time. So I'm trying to develop like a couple of technical algorithms to wake me up to get into these things. But I think the best thing is kind of what Jason does. He waits for like some sort of market confirmation. He calls it like a news failure. I guess it's when, I don't remember what the catalyst for the yen thing was, but like if everybody's offside short and you get bad news and the yen tanks, but then rallies and, closes unchanged or covers or closes higher on the day, you can pretty much be like, all right, everybody's dead. Everybody's going to have to start to cover. So the problem with the market news confirmation thing is you don't get as many reps as I'd like. And I really want to get enough zeros and ones in a spreadsheet to be able to really live test this thing to figure it out. So I'm kind of leaning towards a couple of technical things that I've built. But yes, to long way to answer your question, you absolutely need some other form of go signal, because you could have been short gold as it goes higher and higher and higher because it was offsides long for a really long time.
So since your trades don't come by very often, do you put on a big position size to make up for that?
It always depends, right? Like if, there's a couple of deals I'm waiting for like a final antitrust approval. And, if I can dig that out of a filing or dig that out from a story, or even if the headline hits, but the stock is, not trading at the price yet, I pretty much go until my machine stops, because I have, a 98% confidence level that from experience and from the models and everything that I built, I kind of have a very strong opinion on where that's going to trade. So yeah, if I get a chance to get really big in something, I will. Yeah. Mm-hmm. Or if again, if something hasn't moved like Intel, it's a super liquid stock. I mean, I could get out, down a penny or down 2 pennies through the bid. Right. So again, the decision that's made is usually a very quick one. But if it's like a really thin stock, I'll try to be careful. But again, it could be thin. It could be a thin stock trading at 10 that, I have high confidence is going to go to 14. I'll get really big at 12. If I think it's, even if it's thin, because I know when the dust settles in 30 seconds, 3 minutes, 30 minutes, I know the ARBs are going to come in and supersize. I have a good example for you if you want from the other day.
Yes, please.
So it was early in the morning. Wall Street Journal broke a story on XYZ. It was some dog shit 300 million market cap company, closed at $1.60. And the company, the Wall Street Journal said that they're going to get bought for $3.15. Naturally, it's going to trade higher, right? I missed that the first, blade, because it was, I don't know, early in the morning, or maybe I'm drinking my coffee or whatever. I know that the Wall Street Journal is really good at what they do. It's not one of these other trade rags that's going to be like, maybe it's iffy. And the story pretty much says that the press release is coming, right? So all the guys that were sitting with their fingers on the keyboard, they're buying stock at 170, 180, 190. This happens like in a couple seconds. Then the press release hit. And I start buying stock at probably 220, 230, 240. Now, all the guys that bought 160, 70, 80, they're not merger arb guys. Maybe they are, but usually they're probably not. They're probably just some home gamer sitting around. Or maybe it's an event-driven guy. Or maybe it's a guy that trades NVIDIA, but he's like in front of the screen for that headline. I'm able to very quickly determine with pretty high confidence where something is going to trade when there's a merger arb deal announced. Now, there's so much nuance. It's not like every deal trades at the same spread and the same annualized spread and the same implied probability, because there's nuance to it. But the guys that bought all that 170, 180, they're happy to sell it to me for 240, 250, 260 because they just made X% in a minute. But I know that stock's going to be 301 bid for 500,000 shares in about 10 minutes, because the real ARBs are going to take that thing to something in the low threes, because they're just going to buy it because of the annualized spread, right?
I see. Why would the real ARBs wait that amount of time to get in? Why did they come in after everyone else?
So that's a good question too. They won't wait, but if you run $1 billion art book or $500,000 or $500 million art book, you're not trying to scalp around making 10 or 20 grand like I am, right? They want to really, they might act fast, but they're going to, look at the press release, read it in full, understand what their business is, understand if there's antitrust. Now I'm doing all that stuff very quickly. I'm getting up to speed very quickly, but it takes some time for them to lean over to their trader and say, like, all right, we're going to put some of this on. We're going to buy $1 million at 3, 3 or better. So when you're so big, it takes time to make that decision to commit. Well, this would only be a $3 million position, but you get what I'm saying. Like, if a merger arb fund is going to put 25 or 50 or $100 into some deal, they're not going to just hotkey it. You know what I mean?
Mm-hmm.
There was another one a couple of days ago that I missed, and I tried to buy it at some price, and the arb guys, like the big arb guys, they move faster than I thought they would, so I missed the trade. But back to the original example, I'm buying anything I can at 260, 270, 275, because again, I know in air quotes, but like I know this thing's going to be 3 whatever bid for size in about 10, 15 minutes. I caution anybody doing this because there's so much nuance. I've done this before when I'm not up to speed enough on something, or maybe a page one shareholder is like, oh, there's big antitrust stuff here, and they've got some FDA thing coming out before the deal closes, so there's big gap risk. So again, it's not like, oh, all these things traded like the same spread, right?
Mm-hmm.
But this just comes from experience. I mean, I've been doing it. I've been really looking at event-driven, over 15 years. I've been trading this for over a decade, and I'm not always right, but I try to move fast. The only rub with what I do is it's not very scalable, right?
What does that mean?
At least it's not scalable at good prices, is what I mean. So I could run a merger arb book and buy 1 million shares of that at 3. But what good does that get me if I think it's going to trade at 3? But if I can buy, X shares all the way up to 3, because I'm just me, I'm a little guy, and I'm, keeping all the P&L, then that works. I can make a living doing it.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
Throughout your years doing this, was it possible for you to develop like consistency over time, or is there such variability in these different events with so many different factors? Was it challenging, or were you able to achieve a consistency over time?
Yeah, knock wood, I've always been really consistent at what I'm doing. And like I said, my quote unquote drawdowns are really like lack of quantity of stuff to do.
Mm-hmm.
So like I'm in one of those right now. It's December 6th. Kind of since Thanksgiving, there really hasn't been a whole lot to do for me. So it's tough to like sit in front of the screen and not start trading spiders because it's 2:00 and I haven't done anything.
Mm-hmm.
That's always a recipe for disaster. But yeah, overall, I've been very fortunate. I mean, I work my ass off. I'm up 3:45 every morning, preparing and watching the tape and doing all that stuff. But yeah, it's been a pretty smooth ride. I mean, the only time I start looking over my shoulder, so to speak, and kind of looking at myself, but is just, if I go through these periods where there's just not a whole lot to do, those can get difficult mentally. You know what I mean? Kind of like when somebody just has a drawdown, like a vanilla guy that's, up 5 units, down 4 units, up 5 units, down 7 units, down 8 units, that's kind of my drawdown.
Are there any types of markets, which are super offsides short or super offsides long at this time?
Yeah, there's always stuff offside. Anything I say won't age well at all. Because
Let's
the
say
data.
in an extreme fashion, sort of like a Jap. Are there any Japanese yen equivalents?
Yeah, so I won't even talk about the equities because the equities have just shown offsides long for a really long time. So forget that. But like right now, on December 6th, 2024, some of these G10 currencies are really offside short. The euro, the pound, the New Zealand dollar are really offside short. Mexican peso, not a G10, but that's been very offside short. But you have like a lot of these Trump tariff headlines going on, and there's going to be a lot of movement from now until the inauguration. Some of the metals, believe it or not, are actually offside short: silver and copper. What else here? And nobody's going to trade live cattle and lean hogs, even though I do. But they're pretty long at this moment. But I do like a free. I was doing like a weekly deck for myself a few months back, and I was sending it to a couple of guys that I know trade macro, and they really liked it. So it was kind of annoying to have 50 Excel PowerPoint files on my desktop. So I ended up doing like a free Substack thing. I didn't think anybody was going to read it but me. But there's a couple of guys on there now. So I do like a weekly. It's not event driven at all, but it's all on macro and positioning. But yeah, I usually do it like on Sundays. I'll fire that out for the week. And again, everyone has to have like their own process, right? If you learn anything from the Market Wizards books, it's not, you got to have something that fits your personality because you can never trade like anybody else. I just figured if, there's a couple of macro guys out there that value looking at positioning. So if they can use it to their process, great. And I'm still trying to work on figuring out how to turn this into some green.
Yeah. Well, great.
Yeah.
So to wrap things up, what do you struggle with most as a trader?
It's these lull periods of, like I said before, of not having anything to do because, this happens a lot. And I try to remind myself that it happens a lot. But, if I go another week or two without trading anything, I start to doubt, oh man, maybe it's over. Maybe I'll complain to my wife and she says, yeah, that's the 497th time you've said that. That's the thing that I struggle with the most. And then this positioning thing is driving me crazy because I'm so used to having an edge in what I trade event driven. And I have the P&L to support that. But with this macro thing, it's hard because the typical holding period on my system is 1, 2 to 3 weeks. And everybody's got the data, right? Everybody has the data on the euro and wheat and soybeans and the 10-year treasury. So it's really, really hard. So I'm really struggling with that right now. But it's all good. You got to stay curious, right?
Yeah. So I understand you also on the side are a volunteer firefighter.
I am. Yeah. It's something I started when I was in my mid-30s when I lived in New Jersey. And I kind of feel like I maybe missed my calling joining the military. And I'm driving past the firehouse that I drove past my entire life. And I turned to my wife and I said, should I join the fire department? She says, yeah, why wouldn't you? So pretty cool journey there. Yet, it took me like 9 months to go through the training. You do the same training that a career fireman would have to go through. Mm-hmm. Just met so many great people along the way. And luckily, all my certs transferred down to South Charlotte. So I'm a volunteer fireman also in South Charlotte. But they're just great people. And I always think it's important to do something to give back to the community.
Yeah. Well, thank you for your service. Well, Rick, I want to thank you for coming on Chat with Traders.
I had a lot of fun. I appreciate you.
Yeah, fantastic. And how can our listeners reach you?
Oh, sure. So I've alluded to the tape quite a bit when talking about this. I started a Substack called Off the Tape. It's got underscores off _ tape. And my email's on there like all over the place. So if anybody wants to reach out, and I encourage people to reach out to me too, because it's been fun I've had
Mhm.
people brand new to the business reach out. I've had people been in the business even longer than I have reach out. So I always like hearing about people's process and what they do. And it's a lot of fun.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
I'd ask a question and they tell me, just watch the leaders, watch the leaders. And that always feels like just a brush off. Okay, yeah, great. I'll watch the leaders. Okay, let me give it to you now, right? That kind of thing. But it really does come down to, what do they mean by that? Because the real leaders, there's far and few between of the real leaders. When I'm looking at what I would consider a big group of stocks, I don't know, I think if I look at the entire database right now, I don't know, it's around 11 or 12,000 stocks, let's say, at any given time on a really strong market that's really super broad. My list is about 200 stocks out of close to 12,000.
Markets, speculation, and risk. This is the Chat with Traders podcast.
You are listening to Chat with Traders. Well, Happy New Year. It's still early enough for me to say that, right? I'm Tessa Dow, co-host and producer of the show. This is episode 294, and before we introduce our first guest of the year, on behalf of my co-host Ian Cox and myself, we wish you a year full of true joy and abundance in your lives, and also a year full of intentional action taking in your trading journeys. And I apologize if my mic is not sounding so great this time, as I'm traveling and I'm on a different mic. A year ago, I stumbled across a quote that goes something like this: "A year from now, you will wish you had started today. A year from now, you will wish you had started today." It hit hard because I knew I'd been stuck in my trading journey, letting self-doubt and life's chaos hold me back. All of last year, I pushed myself to try day trading alongside my usual swing trading. More trades meant more reps and experience, but it also meant more failures. Some days I wanted to quit, but something interesting was happening beneath the surface. While my P&L still looked a bit rough, I got better at following my trading rules from barely 30% of the time to nearly 80% of the time. My emotions used to run the show, but it's less now. I started journaling trades, reviewing mistakes, and treating each loss as a lesson. I discovered that if I had followed my rules and used proper stop losses on those big losing trades that I incurred, I could flip my reward to risk ratio from 1 to 3 to a 2 to 1 reward to risk ratio at least. 2024 taught me that progress isn't always visible on the surface. Now, heading into this new year, I'm ready to keep pushing forward. So let me leave you with this question. A year from now, what will you wish you had started today? Now let's talk about episode 294 and who my co-host Ian Cox is speaking with today. He's currently a co-founder of Trader Lion. His name is Ross Haber. With 2 decades in the markets under his belt, Ross's trading philosophy is built on growth-focused strategies heavily influenced by William O'Neill. There he was part of a small but mighty team that turned 15 million into more than 850 million. And in case you didn't know, William O'Neill was a legendary investor and founder of IBD, Investors Business Daily, a true market wizard who passed away a couple of years ago. You will hear his name mentioned a lot in this interview for good reason. Combining both technical and fundamental analysis, Ross emphasizes the importance of identifying leaders in strong market sectors and adapting to market cycles. Optimizing the use of relative strength, moving averages, and volume analysis, and tailoring it to each stock's unique personality, combined with his ability to manage risk through strategic scaling techniques and sell stops, has been one of the cornerstones of his success. Ladies and gentlemen, we're so pleased to present Ross Haber from South Florida.
Ross, I'd like to welcome you to Chat with Traders.
Hi, Ian. Thank you so much for having me.
Yeah, great. Tell us a little bit about yourself. Where are you now and where did you grow up?
All right. Well, I'm actually back where I grew up. I'm actually right South Florida, right in between Fort Lauderdale and Miami. I was born and raised here. I went to University of Florida, started off as a retail stockbroker after I graduated. So I grew up in South Florida, went to school in Gainesville, came back down south. I was lucky my parents gave me my room to live in while I figured it out because I didn't want to go back for a master's. I got a job as a retail stockbroker at, I think I mentioned to you when we first talked, Oldie Discount, where the first book they gave me was William O'Neill's How to Make Money in Stocks, right? So that was the very first book I was given after I finished business school, on the real stock market. That's not what you learn in school. And long story short, one of my clients was a big O'Neill fan, introduced me to the manager of institutional sales there. So I finished UF 95, February 98, I was in O'Neill's institutional sales, building a client list of hedge funds, mutual funds, what have you. Along the way, one of my hedge fund clients made an offer for me to come run a fund with him. And so, I was expecting to get walked out the door when I came in to tell my boss at O'Neill that I was going to run a fund with, XYZ client. Rather than walking me out the door, I had the luck and blessings of Bill actually offering me a job to stay and run money at the firm. That is what I wound up doing, building a track record, getting to travel around the country, teach the workshops with Bill. And that is what ultimately led to my experience running a hedge fund in New York for 6 years with a fellow by the name of David Fellman, who used to be the mid-cap portfolio manager of Fidelity's mid-cap growth fund. That's the long and the short of it from, graduating from college to, I guess, hedge fund land. And then from the time we closed the fund in 2010, I've just been managing my own money. And over those years, I had started a newsletter, very small, I was on Twitter. Let's just say it wasn't really amounting to much. I felt like I was spending more time than it was worth. I was in the process of shutting it down when I wound up meeting Ray and Nick and Richard and starting the whole Trader Lion and Deep View thing. So, Trader Lion started about a little over 6 years ago. Deep View's about 2 years in the making. And so that's it from, kid until now as my hair is falling out and turning gray.
So tell us about some of the things that you learned from this first book that you got, How to Make Money in Stocks, which has been around for a long time. And did you apply what you learned in that book to your own personal trading account?
I did. I mean, that is actually that is what got me the offer. Doing well in the market, applying what I learned from Bill O'Neill was I generated a great track record. So when that happened, I was doing very well on my personal account. At that point, there was still really no online brokerage. So there was a institutional brokerage for the clients to trade. But if you were absolutely encouraged to trade as an employee there, however, you had to have your account at Stockmart, which was the in-house William O'Neill trading desk, right? So Bill could check your account. He had access to everything. So that was actually what led to Bill considering keeping me around, as well as him. At the time, there was just one of us that would, travel the country and do the workshops with him. And at that point, he had required at least 1 year of triple digit performance. And I had been blessed enough by the 98 through 2000 environment. And obviously having Bill O'Neill at my side 5 out of 7 days a week, I did solid triple digits, 98, 99, and 2000. So yes, absolutely. And I would say this, I think there's a lot, right? As we've discussed, the methodology has been around out there for a long time. Lots has been developed since. The dissemination of information now compared to then is unbelievable, right? So, I mean, to know what it was and really get it down in detail was a much more difficult task than it is today. I would say, so while you might hear a lot of people discussing breakouts don't work anymore, or Can Slim is old, or that sort of thing, what I would say is it was old before Bill O'Neill started it. It came from Jesse Livermore, Nicholas Darvis, and all of those older traders. Bill basically expanded on it, added more detail to it. I think the big thing we all know, for example, about Jesse Livermore, I mean, you could say what he did didn't work, right? Because he ultimately wound up killing himself after a ton of losses. So I think I'm getting off track.
If you could take us back in history to this famous trader, Jesse Livermore, and share with us, how did he get so wealthy? How did he get so famous? And maybe even how he failed in the end, and how that ties into the book, How to Make Money in Stocks.
Sure. So that one so that's required reading from O'Neill. If you start there, everyone in the firm is, you've got to read his book, but Reminiscences of a Stock Operator, I think, is probably the most well-known, Jesse Livermore book. And it discusses really from the beginning of the stock market. Jesse was one of he was a young kid. He was one of the guys who actually changed the prices up on the chalkboard, right? As this was before the ticker tape and all of that. And so as he was one of the guys responsible for changing stock prices as the market went on throughout the day, he noticed certain patterns, right? Basically what's going up typically continues to go up, and what's going lower often continues to go lower, right? The whole basis behind trend following and understanding the direction of the general market, which O'Neill has developed a very specific methodology for. It's one way. There's a million ways to do it. So, and fortunately enough, we had him put together in a book those observations, what he was noticing. At the end of the day, though, he did not have a specific system for managing risk, right? So Jesse Livermore, if I'm not mistaken, I think on the stock market crash of 1929 made himself either $100 or $200 million, right? They blamed him for crashing the market. At that point in time, that was an insane amount of money in today's dollars, as you can imagine. The problem was he would make that much money and then give it all away, and then make it again and then give it all away. And in the end, he wound up divorced and unfortunately putting a bullet in his head. So I would say Bill's big contribution was at understanding that was the big, so I think he had the buying part down, but managing risk is a big part of what Bill has added to it. And, what I would say is this, from what Bill has discussed in his book to where we are today, there's tons of trade. So I have taken what he's taught me and made it my own, but no doubt I've put my fancy new rim on Bill and Jesse Livermore's wheel. I don't think I've created anything new. I think there's a lot of guys out there that have taken that style of growth trading and made it the foundation for what they have made their own. I don't want to start with one name and then forget guys out there, but there's tons of guys out there with books that sell off the shelves that are, super popular on Twitter, that have won those United States investment championships, that I could confidently tell you have all based their methodologies around that style of growth trading. So I would say this. During that time, it was much easier. Okay. Counting distribution days worked like a short-term sell signal. I could almost tell you flawless. I felt like a magical genie doing it. I couldn't believe it just continued to work. And while I would tell you that largely no longer works, and while I still look at distribution and apply it in a different way, there are other things, for example, that I continue to use that work. On the flip side, relative strength, new highs ahead of price. Understanding exactly what that is and when to use that works as good today as it did in 1890, and I can tell you will continue to work in another 100 years.
So you mentioned that some things don't work like they used to. Why do you think that is, and why do some things work and some things don't work over time? And do things that don't work now, do they come back in favor? Is it like a cycle? How does that work?
I'm going to give you the fortunately and unfortunately again. I've been around long enough I would say not long enough to know if it's necessarily a cycle for all of them. However, I would say there are things like that work really well once and that I have never seen work again like that. And I can think of other things unrelated to CanSlim that used to be the big hot thing that no longer work or are even a focus. And there are others that will work really well in certain environments, and then certain things that I have observed to just work. Related to CanSlim, like I would tell you, relative strength new highs ahead of price. Not related to CanSlim, that I know is built into, most of the guys who are algorithmic or high frequency traders would be Fibonacci levels. Why? I know guys in the business who are extremely successful, who have been at it from the beginning, who will tell you why does everybody do it? Because they work. As much as I'd like to tell you that, maybe that is what has made it so that distribution days are less effective, I can honestly tell you that isn't what happened with fib levels, because fib numbers still work as good as they always have. And from what I understand, and maybe this has changed because it's a conversation I've had several years ago, but from what I understand, the reason that, that is built into most of your HFT and algorithmic programs is because they simply work. So, so I don't think there's a single answer. I think it just depends.
So you mentioned CanSlim. Tell us what CanSlim is. Let's go down and describe for our audience the components.
CanSlim is the acronym CANSLIM that represents the 7, is it, most common characteristics that. So this is what Bill O'Neill did, is he did a study of the most common characteristics to all of the biggest winning stocks over time, starting back, let's say, late 1890s. I know he's got the guy. I'm still tight with the guys who have continued to do that research up until today. I don't know where they are with it, but they have told me over and over again that in terms of price and volume, interpreting price and volume, the way that it works, nothing has changed. I mean, sure, the rules of the game have changed. I would tell you that the old, market makers, HFT and algo are your new market makers. Whereas I can tell you if you looked at a level 2, there were before SO's bandits showed up on the market, there was one electronic communications network, Instanet, INCA. There was no Island, Arca, or any of that stuff. And to have an Instanet machine, you were typically a large institution. Otherwise, if you looked at a level 2, on the top left of the bid and top right was Goldman Sachs, Merrill Lynch, Morgan Stanley, JP Morgan, you name it. Now it's just a bunch of ECNs. You have no idea who's there. all of the big brokers are at the bottom. And so what I'm telling you is all of those guys who used to actually pick up a phone and talk to each other in the late 90s, early 2000s, before, everybody was a market maker, and now largely, so it makes sense. The HFT and algo guys are highly dependent on computers, AI. So before, when you had a bunch of young guys on the phone playing games within the rules to quote unquote, and I don't want to get a whole thing, at least short-term trick investors, I want to say manipulate without making it a bad thing, because they're not doing anything wrong. They're, when I say manipulate, they're manipulating, they're doing their job, trying to make money for the firm. I learned all of this on the retail side because I worked at a discount firm where I got paid splitting the spread with the market maker. So I was explained very clearly by these guys what they were doing to make it look like a stock was weak in the morning that they were really going to buy, and vice versa. Now you just have computers operating with those rules at nanosecond speed, right? So it's a different game, but the same game with different rules. And that's why ultimately it all still works. And here, I would tell you this, I can't watch the leaders, right? The action of the true leaders of the market and understanding rotation from into and out of leadership, what a very strong market looks like, how many stocks it takes to really get a trend, a sustainable trend, I should say, up and running, versus how many stocks it takes to maintain a strong uptrend that is petering out. Those things that I learned from Bill still work like a charm today. And so that's the stuff that I employ. And to kind of, make it my own, I've sprinkled in some Stan Weinstein, right? So I've got my early buy points, what I call consolidation pivots instead of base pivots, which are much earlier up the right side. And if I can combine that with my relative strength new highs or relative strength line leading price that I all came from Bill, that stuff all works. I mean, that's my moneymaker. It was in the in the late 90s when I started, and it is to this day. Over time, I pay attention to what used to work and still doesn't, what works maybe differently, and what, used to work, stopped working, and might work again, right? Or how it becomes relevant in a different way. Let's say watching the VIX or other sentiment indicators, right? I think there was probably a time where put call was really a great timing tool depending on the environment. Now, in and of itself, it doesn't do much. So, and this is just one thing. So yeah, I've learned about all of those contrarian sentiment tools from Bill, whether it be put call, the VIX, the IAA investment sentiment, the newsletter writers, bullish, bearish, that sort of thing. And so each one of those things used to be an awesome tool in and of itself, whereas now I find that if I am going to watch those sentiment tools, I want to see at least 3 of them at an extreme, right? So if I don't see at least 3 at an extreme, if I just see a spike in the VIX or just a spike in the put call, and I'm not seeing confirmation for at least a couple others, and we're not near extremes on all, I will always defer to watch the leaders. What are the leaders telling you? How many setups are there? What groups are they in? Are they later in their moves, right? We learned from Bill O'Neill in CanSlim, and I got off that topic. CANSLIM is the acronym for all of the most common characteristics to those big leaders, right? C, current quarterly earnings; A, annual earnings; N is your new product.
Let's talk about the first 2 letters, the C
Sure.
and the A, and what do they stand for, and how important is this in the CanSlim strategy?
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
Awesome question. And I'll tell you, extremely important. If you were, talk to Bill O'Neill up to the end, he would tell you it's 70% fundamentals, 30% technicals. And for him especially, I was there, I watched it happen. That guy put massive amounts of money into one or two stocks. He did that only with your highest quality, most liquid names so let's start with C is your current quarterly earnings, and A is relevant is your annual earnings. He discovered that. Now, what is your biggest winner? So a big winner to him, it had to be institutional quality for starters, meaning a Fidelity or an AIM mutual fund has to be able to buy the stock. A big fund, it can't be a thin little $5 thing that trades $500,000 total volume a day. That doesn't really, so it has to be a stock that can be bought and sold by a legitimate mutual fund, right? So it can't be a tiny little thing, and it has to have, and so he noticed as long as it was of that quality, buyable by, high quality institutions, that the majority of those stocks had so it's going to be year over year quarterly earnings growth, meaning not fourth quarter compared to fourth quarter, but fourth quarter this year compared to fourth quarter last year. So that's year over year quarterly growth, and that eliminates your seasonality and all of that stuff. So that is how, at least I was taught to look at quarterly growth. And so if you buy the book, it'll tell you want to see at least 25% growth for the most current 3 quarters. And you learn that's a bare minimum. I require triple digit growth, preferably accelerating triple digit growth. Now, there's very few of these, as you can imagine, right? Because then I'm going to have my rules for annual earnings, right, from the book. And if we move on to N, right, that N stands for new product. Well, we'll hang on there for a second. So anyway, on the earnings front, I'm personally, I've got the basic rules. Can Slim tells you at least 25% quarterly year over year. On an annual basis, it's a little easier on the restriction. You're at about 20% for 3 years. Obviously, more is better. Triple digit is better. Harder to grow annual earnings at a triple digit rate than quarterly, obviously, right? Especially over a long period of time. But 70-80% of the biggest winning stocks, met the criteria that he came up with, right? And he basically went through every stock out there, the database of whatever it was at those times, and figured out of, the stocks that made the biggest moves of institutional quality. I'll always throw that out there. That gets rid of all the tiny, low price junk. But the high quality stuff, those were what you're looking for in terms of earnings. I mean, right there, if you put all your money in, if you're going to be putting half your account, and if you're Bill O'Neill, half your accounts, all of your account on of cash, and then the other half is margin, right? So, and sometimes he would, be 200% one stock, a lot of money, maybe two, or 80-20 split between two stocks. And I mean, that's how, we had a huge run up. I was one of, so I became a portfolio manager at the end of 98, beginning of 99, and got to participate on that, 98 to 2000 run. We started with around 15 million bucks, I want to say a little less, and finished up in March of 2000 with 860, if I'm not mistaken, about 850. So we went from about 15 million to 850 million in about two and change.
So in the C and the A, the current and annual earnings, does this system factor in whether they beat estimates or factor in forward earnings projections by analysts? Does that matter?
So that was never, let's say, part of CanSlim in the book. However, I think if you were to go talk to the IBD folks now, or me, or just about anyone, that has definitely become part of it. So if you were to go check out the latest edition, the orange, How to Make Money in Stocks, I don't remember if it talks about analyst estimates, but I will tell you that is definitely an important part of it. So while, again, it may not be in the textbook, it absolutely plays into what I'm doing. And I know many of the guys who are employing the strategy overall, or at least on a basic level.
Okay. And then what does N stand for?
All right. So N is either a new product, new service, or new management, right? So with Apple, it was the beginning, we all remember the original white iPod with the disc on, right? The gray disc. And that is what morphed into our iPhone 16 with AI and better cameras than, we probably ever used to have as a camera in general, right? Or video camera for that matter. And so a new product, new service, new management, what that's going to do is help solidify, again, the quality of the company you're looking at. Because you can have a smaller company that comes across, let's say, in a technical cycle. I'm going to use a big, huge winner, iOmega, right? The big hard drive stock way back when. It's irrelevant. It's out of business. No, right? It's irrelevant technology now. So there are those, right? The iOmegas that pop up with something new. It's a huge success, and then it becomes an irrelevant technology, and maybe it gets bought up or they move on to something else, or it's something like an iPhone that, their product turns into, the entire Apple architecture environment, right? If you've got, it took me a long time to finally get myself a MacBook, but once I opened that MacBook and it connected my iPhone, I couldn't believe it took me that long, right? Like it's you can't imagine how unbelievable. And, and then I really begun to understand. And so you want to understand the type of company you have, but it is very important to know that the service or product that company has is something that the phrase we use, changing the way we work, live, play, or communicate, right? Sometimes that will go on for years and years and decades. Sometimes it'll be a flash in the pan kind of thing with technology, and sometimes it'll be, it can be the biotech. Remember Regeneron with macular degeneration. I think the eye, you get a shot in your eye now. It's expensive. I mean, what a great thing for them. It's a few $1,000. You get a shot in your eye and you go from blind to being able to see, right? And that's never, so that's never going anywhere. That's a new technology. Everyone's going to want to be able to see until something right newer and better comes along and makes that shot irrelevant. I don't think that's happened yet. But yeah, so you want to make sure that you have a very sound service or product behind those sales and or earnings, right? Earnings are ideal, and we can get it. I don't want to get too far into, but there are times, and again, this is kind of a development outside of the book where, I'll tell you, a stock may not have those massive quarterly and annual earnings, but there are times where the big institutions put a premium on not even massive, powerful sales, but just steady, consistent, stable sales. So stable revenues get a big premium from large institutions as well. I'm just throwing that out there, right? Because if you ever hear me talking about a leader that doesn't have the earnings, check out the sales. That's usually going to be the story.
So then the S in CanSlim, does that stand for?
Yeah. So actually that is supply demand. I got into, so let me back up. A and C is quarterly and annual earnings and sales and revenues. So let's back that up. Along with your quarterly, like I said, you want to, minimum was 25% year over year quarterly growth. I'm looking for triple digit. Same sort of thing for sales. So at a bare minimum, you want to see sales supporting those earnings, right? I don't mind if I see super huge, stable, solid sales and funkiness going on with earnings. That's why we look at non-GAAP versus GAAP, so I get an idea of what's going on there. However, if I see phenomenal earnings and sales that don't support that, that immediately raises a red flag, right? And if you got no money coming in and, these magical, beautiful earnings, there's, clearly something going on. So that's why I always say at a bare minimum, if the earnings aren't there, they're not solid, or they look at, you've got triple digit here, but then a loss and then solid double digit growth here followed. As long as if I'm looking at 3.7 billion this quarter, 3.9 billion the next, 4 billion the next, then right. And I'm just seeing a steady march from 3.6, and I'm seeing estimates look for it to slowly be at 5 and 6 billion, going out into 2026, let's say. That makes me okay with volatile quarter over quarter earnings. However, if I saw, earnings that look spectacular and these tiny little quarter over quarter revenues, right, that's a problem.
So what does the S stand for again?
So that's stood for supply and demand. And I would say, Bill would even tell you this. He might even discuss it in the latest edition. I would say prior to 2000s, when that 98 through 2000 run, your ideal stock to have an explosive move would be more of the mid to big cap areas, or even small to mid, meaning the smaller float and the smaller shares outstanding is just easier to move a stock up, especially if it has big earnings and a big story. Now, not so much. Now it's gotten to the point where, you can see these really big cap, super liquid names. If they've got something going on in the powerful earnings, they can move like those smaller float, smaller shares outstanding stocks used to. So I would tell you, and again, I haven't talked to them about this one in particular, but I would bet if you were to confirm it with the IBD folks, they would tell you that is the one part of the acronym that matters. I'm not going to say it doesn't matter, because supply and demand is supply and demand. It's easier to move a stock with less shares than more. However, since the 2000s till now, the stocks that Bill would typically shy away from because they would move too slow because of their size can now move like they were much smaller. Why that happens, I don't know. It's just one of those, right? So we just know that there's no reason to stay away from super large cap stocks, because a Google can rip to the moon, just like, let's say, a Shake Shack can, which obviously is a much smaller stock, or a Lululemon when it's newer and, under high demand. Something like that's going to, typically move a lot sharper and faster in a shorter amount of time than an AMD, or one of these really, or maybe not even that one, an IBM or even a GE, one of these bigger, slower, high-priced, super liquid names. Not so much the case anymore. My guess is if you put AI quantum computer story with GE, especially a GE spinoff or something, it'd go to the moon. Doesn't matter. As far as the supply and demand thing goes, I don't even take that into consideration anymore, as long as there's momentum in the stock and I see that it is moving, and especially if I can look to the left historically and see that it's something that has had super sharp moves in the past. I don't care how many shares are outstanding,
What about the L?
So that is leader or laggard, which is a big deal. So the system basically, ultimately following the CAN slim, so you're trying to find the strongest stocks with the best CAN slim fundamentals, which we're going through now. So I want the stocks with the highest quality CAN slim fundamentals that are the strongest stocks in the strongest groups, right? And that's the technical part. So again, I just separating that as we're going through this. These are the fundamentals. So leader or laggard, and that's why I'm saying this is more of, it's both quantitative and qualitative, right? On a quantitative basis, it's very easy to separate out the leaders by earnings, price performance, relative strength versus your laggards. From in that perspective, it's very easy. But leaders versus laggards, you want to understand more generally what are traditional growth stocks, right? Because you don't want to. When I see today, I look at what led the market today, or just on a very short-term basis, I can look and see. I have a watch list of all of the sector ETFs that I sort by price percentage change. And if you look, it was gold, Bitcoin, and I can just tell you in a heartbeat, builders, software, and for whatever reason, small caps and the industrials rallied today while the NASDAQ acted a bit weaker. And so I'm constantly keeping track of that to see rotation and leadership. That's a very big thing. So what is leading, let's say quantitatively, at least price performance wise? And then when I'm looking, are those groups that I consider growth or defensive? And then if they are growth stocks, when I go look at those stocks, I'm immediately going to look at the top, 5 or 10 highest relative strength stocks in those groups to see, are they of that hand slim quality? And if they are, what do they look like on the charts, which we haven't gotten to yet? And, what cycle of their overall move are they in? Am I looking at a group of stocks that are coming out of early stage bases that look like there's, they have similar patterns, tons of accumulation, great earnings, so on and so forth, right? Is the rest of the sector looking good? Or are we looking at gold stocks, utility stocks, and, or is it a flight to safety sort of thing? And it's this balance of rotation back and forth and where, understanding where everything is in those groups, and what they are relative to the market. That's a little long and convoluted, so please redirect me.
Yeah. So let's jump to I.
Okay. So there we go. Institutional sponsorship is the I, and very basically, you want to see increasing sponsor. So let's get to the why institutional sponsorship is important. The majority of the activity, I'm going to tell you, 70% plus of the volume is coming from the institutions. The idea is to find the best stocks. You want to, so not only do you want to find stocks that the institutions are increasing their positions in quarter over quarter, which you can also see depending on what database you have access to. Ideally, you want to see high quality institutions accumulating shares quarter over quarter in a stock that's early in its move, right? As there does come a point where institutions have been accumulating quarter over quarter and a stock is late in its move and it might be telling you something else, but you do want to see that large investors are accumulating your stock along with everything else. And so that's where the I comes in. And believe, this is just something that's stuck in my head from sitting in meeting and having tons of conversations and doing the workshops with Bill, where he would tell you the S is fairly irrelevant these days. He did put a ton of importance on institutional sponsorship, especially the quality of the institutions that are accumulating your shares. He looked at that was a big deal to him. I'll just leave it there without going on and on.
Okay. And then the last M.
And that is the market, right? The general market, is it going up or down? That's where, we can discuss the follow through day, which was the technique Bill used to determine, it was the quantitative side of determining the direction of the market. There's a qualitative side that is equally, if not more important. So M is the direction of the market. And I'll give you a direct Bill O'Neill quote. He was a big baseball analogies were his favorite. He'd tell you getting the direction of the market right is 50, at least half the ball game, I think is what it was. Because if you don't have the direction of the market right, 3 out of 4 stocks follow the general direction of the market. If you don't have that right, nothing else matters.
And how do you determine, what kind of technical indicators do you use to determine market direction?
Largely the 2 indexes that I was taught to use by Bill and, William O'Neill, we all called them Bill, just to clarify, was the NASDAQ and the S&P 500. Those are the 2 that matter. So he looks at the NASDAQ volume, and believe it or not, S&P price versus NYSE volume. That is what he used. He found that I get more relevant for whatever reason. So let's just make that clear. It does kind of make it a pain in the butt sometimes to have to, specify different volume for your S&P chart. But if you're ever wondering, when he's counting distribution days on the S&P, he's using NYSE volume, not the S&P 500 volume. But anyway, if a market is in a downtrend, using either one of those indexes, either index, the NASDAQ or the S&P, has to have a follow-through day. They don't both have to have one. And what a follow-through day is when a market is in a, falling and in a downtrend, you will be watching for the first day up. And once you get your first up day in the middle of the market free falling, that's your day one. And you are going to count days until you either follow through, and a follow through day ideally happens between days 4 and 7 after that first day up. So the market needs to be up at least 1.75% on more volume than the prior day. Volume doesn't have to be more than average. It doesn't even have to be big. It just has to be bigger than the prior day. So an ideal follow through day, I say, happens on days 4 through 7 because equally valid follow through days have happened on day 17 and 23. And so then you go, well, that's great, right? Because, what I'll tell you is there's never been a new bull market or new uptrend ever in history that wasn't preceded by a follow through day. However, and this is the big however, not every follow through day leads to a new bull market or significant uptrend. And so what's the difference? And this is where I say the learning the health, breadth, and that the rotation of leadership makes all the difference. That's why I always say watch the leaders. So I can tell you, when you're in a sharp downtrend, and you will get, right? So it makes it very difficult. And this is why we're on day 4 through 7. Days 1, let's say days 2 and 3, it's not uncommon to see bear markets have some of the biggest rally back days for 1, 2, or 3 days before they roll over and die again. So for Bill, it was that fourth day on that 1.75% on more vol that put him out of that, okay, it's just a 2 or 3 day thing that can die. That is, after doing all of the tests, looking at all of the market bottoms, this was back tested, right? It wasn't just an observation. He actually had me, Mike Webster, Charles, and everyone that came before us and everyone that's there, well, not now, but, go through and test all of this. So the deciding factor is going to be, it's always going to come down to the qualitative, right? It's very easy. Everyone can figure out when a follow through day happens based on the quantitative rules. And then it's going to be, what do leaders look like? How are they acting? How broad are they? What stages are they in? And that sort of thing. And that will always, always, always be the difference. I'm not going to tell you I can get every single follow through day right, which ones work, which ones fail, but I can give you a great idea of which ones are going to work and which ones aren't based on action of the leaders.
How would this system characterize the current market that we're in on January 14th?
Well, I mean, I'll tell you right now, I've got pushed to cash towards the end of last year, just based on my system, a lot of what I have. In general, I use the 21-day simple moving average as a line in the sand for me. So once, the stocks start breaking, and a lot of, depending on it, personality of the stock is a very big deal. So if I'm using a 21-day moving average, the stock, it has to be a stock that actually respects that average. Otherwise, I'm going to pick another one. In many cases, I'll find many stocks just happen to respect that 10. And when they break it, they'll fall to the 21. And if you want to get fancy, I have found when they break the 21 simple, the 23 exponential will pick them up. Same thing when stocks I have found break the 50-day simple, the 65-day exponential will pick them up, and I will make. But what I'm getting at is, depending on the personality of the stock, I have a very specific line in the sand relative to my performance in the account, in that stock, and where that stock is overall in its run versus where I would expect from it.
So my understanding that part of the process of acquiring stocks through the CanSlim method is connected to the concept of scaling in.
Yep.
So how much to scale in and when? I mean, how do we scale in?
So this is one of those things that I'd say still works, but much less so than it did in 99. In 1999, you could buy breakouts, chase strength. I would even tell you in 99, if you refused to chase what looked like an extended name, you were just left in the dust, which is a bad habit to pick up 20 years ago, because sometimes it still seems to take over my brain, and I will tend to buy something more extended than I should. Anyway, but so in that respect, things have changed. It's certainly not as easy. You can't just buy any growth stock with some you can, right? If they're liquid enough and you get it in the right environment on the right day, you can buy a breakout, set yourself a 3 to 5% sell stop and never look back again. That I would say doesn't happen so much anymore. I would say over the last 20 years or so, it has gotten significantly more volatile. There was a time where I felt like I'd be on 200% margin and I needed another 200%. Now, when I'm 130% long, I feel like I'm at that 200%, and I'm on day trading buying power. So, I mean, and maybe that's come with age, right? I started with O'Neill when I was 26. Now I'm 53. So, maybe that's part of it. I like a whole lot less aggravation now. I definitely, so that doesn't work as well anymore. I would not suggest waiting for a stock to break out and then adding higher, right? If you were to follow the book by the rules, let's say you found a cup and handle base, and the pivot point or the buy point on a cup and handle base is when the stock goes through the high of the handle on big volume. And that used to work phenomenally well. And I would have to tell you now, with the volatility, while that stock still works within the realm of the rules, and I don't know how detailed you want me to get on this, meaning that I have seen stock, they will break out, fail, it takes the third and fourth breakout, but after they fail, assuming they were a canceling stock that broke out of a first, what we would call an early stage base, even though it took the third or fourth breakout, the failures never took it more than 7 or 8% below the buy point. And the reason I say this is because that 7 to 8% that you hear all of FinTwit talk about as their max sell stop, and a lot of it comes from how to make money in stocks. So there's one reason for that. That 7 to 8% is mathematically where once you start losing more, once you start getting close to 10 9, 10 and more, the bounce back becomes significantly harder. But that's only the first reason. So for that reason alone, you never want to let a loss get more than 7 or 8% away from you, because it's harder and harder to remember. You lose 50%, it's 100% gain to get even again, right? And so the further you get below 7 and 8%, the faster that sort of flip flop happens.
So, question: do you think CanSlim is a good system to automate?
No.
Why is that?
I just don't. I think maybe it would take consistent updating based on the environment. Mm-hmm. I don't think you could turn it into a black box. I think I think many have tried and it just doesn't. There's too much qualitative analysis to confirm the quantitative for the computer to do it for you. Mm-hmm. I'd say environment makes a big difference. The personality of your stocks, the way. So, and what I was getting at, progressive exposure, and I'll keep it very simple, whereas Bill used to talk about you buy a breakout and then you add a little more up 2.5%, and then you add more up another 2.5%, and you let it ride. In today's market, that's a great way to get yourself absolutely shaken out and beat up your account, to have the stock ultimately never fall that 7 or 8% anyway. And so there's a lot of that goes on. There's a lot. So that's why I'll tell you the environment, the kind of stock you're picking, and then based on its personality, how you're buying it makes a difference, right? So there's going to be certain stocks that I buy on strength, certain ones that I accumulate on weakness. I mean, I've gotten to the point now where the personality of a stock is of key importance to me. I'm only trading, for me, because I figured this out over time, that tight liquid stocks that respect their moving averages and have an ATR of so little are perfect for me. The big bad and I'll give you a perfect one I always go to it. ServiceNow, NOW. Look at a weekly and a monthly chart of that stock. It looks impossible to lose money on. One of the best stocks out there. And the thing goes straight up. I've traded it countless times. That thing steals money from me. I can't trade it. You know what I mean? So that's what I mean by personality. I can pick the best stock in the market and lose money trading it every time, right? With even if Bill was buying it and kicking butt, so that's why and this is a whole part that isn't discussed at length, but I think is the whole psychology of trading, right? I can put you in the room next to Bill. You can try and copy him, and there are so many things that can go wrong. He could give 100 traders, 100 winning trades in a row, and 90% of them will lose money.
So I did a little search for funds which trade this CanSlim method because it's been around for so long and it's probably very well known given how long the book has been out. And I only was able to find one fund, one ETF called the IBD 50 ETF. Do you know of any others that are traded? And if not, why?
I would tell you this: most funds hide their chart guy. Okay, I'm going to tell you, no joke. Okay, so at my fund, I was the chart guy. We had 4 fundamental analysts that were with us for 2 of the 6 years because I guess my partner David had the fundamentals down pretty solid. He was very lucky. He was taught by Jeff Vinnick, who was the portfolio manager of Fidelity Magellan Fund way back when. If you look him up, Jeff Vinnick, he was kind of a big deal. He's the one who taught my old partner David. It was kind of cool. So Jeff actually invested in our fund, and so in running that. So let me tell you. So I wound up becoming David's partner through William O'Neill. Right? He was a Fidelity portfolio manager and client of O'Neill. He actually paid to speak to, I don't want to start blasting out names, one of the bigger guys at the firm. And so that's who he tried to hire away, someone above me who didn't want to leave. And so I was introduced to David. And here's what I learned. So even though he was a big growth investor and had a huge respect for what we did, right? He wanted a chart guy. But I don't think I could name you another guy, or at least that would say it in public, that they look at charts. It's like, I can't tell you how many meetings where there were plenty of meetings where there were institutional guys, right? We had a lot of fund-to-fund investors that were very interested in what I had to say. And there were others that didn't want to hear a word about charts. In fact, it would have scared them away. And what we did was very, very largely based on what I did, which melded very well with what David learned from, his mentor, Jeff, whereas mine was Bill. And the combination of his fundamentals with my technicals, right? The chart guy worked magically. We did very well. But I will tell you, there were meetings where, David would be like, Ross, yeah, you don't have to come to this meeting. You understand, right? Right? Because the chart guy will send them running, and they think it's like this hocus pocus. They don't want to hear about this line and that line and the volume. And more than anything, and I'll tell you, this really became a big deal and related and unrelated. But after, Bernie Madoff and the whole big crash in 2008, if you don't have a fundamental guy with, a Harvard, 5 guys from Harvard because when something goes wrong, and inevitably it will, and you wind up in court, they don't want the hocus pocus chart guy getting laughed at by the judge. They want a smart guy from, a big fund and Harvard Business School that can tell you coherently why they picked that investment based on numbers and not this line and that line. Are you with me? So that actually, so I would tell you this, while I am aware of, because being in institutional sales, you will find out that, so I used to be on the phone calling. It's different. I was smiling and dialing, talking to guys, and you're like, oh, William O'Neill. Oh, you mean the chart guy, right? It's funny, I'd call big, hedge fund, mutual fund, whatever it was. Oh, the chart guy. And some people you could get through to and explain, yes, the chart guy, but let me explain to you how and why it's important and it could help you, and why it is worth understanding supply and demand in addition to all of your Harvard fundamental education, which I'm not poo-pooing at all. It's fantastic. However, it goes hand in hand with the technicals. The guys who combine both do far better. I would say this. So the technical part, I think a lot, is used by many and not talked about because it's looked at as, hocus pocus that they don't want to admit to their clients. I'm just being honest. And yeah, if you were to try to go out as a young guy and try and find at a job, like you're saying, at like a CanSlim fund, good luck. You might find a few small hedge funds if you really look hard, but it is, yeah. So That is exactly right. So while a lot of the technical knowledge is applied, there are very few guys out there that, and if you think about it, what Bill's whole thing is looking at historical earnings. Every fundamental analyst out there is on a spreadsheet right now projecting earnings 3, 6, and 9 months out. They couldn't give a rat's butt about what they did last quarter, the quarter before, and the quarter before that. So when you tell them that you don't even have to predict anything, you can just look at what they've already did. They want to hear none of that.
I'd like to jump into some of the criticisms
Sure.
About CanSlim. One criticism says, CanSlim prioritizes growth stocks with strong earnings and sales growth. This can lead to an overexposure to highly volatile stocks, particularly in bull markets. I'd like to get your take on that.
It absolutely can. This is what I like to say. I think the stock picking is the easy, fun part of it. The part that matters is risk management, position sizing. Although I would say risk management could be a whole big book in and of itself. If you are not careful about what you were doing, how you were buying, and where you were buying, and I used to tell people this, there was a point, especially back then when I was braver and younger, and I would try and emulate Bill. I'd have my account 200% long, 180% of my money in this stock and 20% in that one, or 170 and 30, I don't have a penny left to spend. And that would look absolutely insane to the average guy, right? Especially an institutional. They're like, it looks stupid. It looks dangerous, right? Ross, you're in 2 stocks. These things could fall apart. But the way that I bought them, I'm actually managing risk and have much better control of my risk than your guy that's buying 120 different stocks. Are you ready for this one? Diversification is a hedge against ignorance. And I know that can sound egotistical, but as long as you are managed, and I learned this from Bill, as long as you are buying those stocks right, you are starting at the beginning, building exposure progressively, correctly, ahead of time, it is absolutely possible to continue to do. I can tell you from this year alone, my business partners who I've been, are also very good at that. I'll tell you one in particular, he does an incredible job of, again, he's taken the methodology, made it his own, and I have yet to see anyone do it better.
Another criticism talks about market timing dependency. This method emphasizes buying during uptrends and exiting during market weaknesses, requiring precise market timing.
Yes, it does, right? And it's funny, I'll tell you, I did, not Harvard, but University of Florida Business School, where we read a random walk down Wall Street, and you'll inevitably have a professor, if not more than one, tell you that it's impossible to time the market. And I can tell you with the utmost confidence that it is not impossible to time the market. If trading's, you've got to treat it like your profession and not like the casino. I would say if you don't have like the full time to dedicate to it, I mean, at the end of the day, listen, Warren Buffett will tell you the same thing as Bill O'Neill, and he even has this in his book, right? If you don't have the time to really dedicate your to it as a profession, your best bet is to buy funds, high quality funds and ETFs. Buffett, who's the complete opposite, he's a value guy. He's buying, Goldman Sachs when it's beat up in 2008 based on fundamentals, not the charts. And but they'll both tell you 90+% of the professional money managers on Wall Street don't beat the market. So what makes you think you're going to be able to do it part-time? Buy either buy yourself some index ETFs, or if you really want to get fancy, you can get yourself a Morningstar subscription and, find the stocks with the best long-term 5-star ratings. Doesn't matter what they've done over the last 1, 3, and 5 years. You want to know what these guys have done the last 10, 15, 20 years. And you just keep buy them high, buy them low. Listen, I've done it for my brother who hates risk. And honestly, it is so aggravation free. Sometimes I wish, why don't I just do that and add 10 years to my heart? You know what I mean? The older I get, the less aggravation I'm into. So yeah, I mean, I've been very lucky. I think I've done a very good job of doing incredibly well when the market's been good. And I've never sustained a terrible drawdown. Following the rules has always gotten me out somewhere in and around the top. but it's been my career. I have the luxury of having Bill O'Neill hold my hand and teach me every day for 5 years, right? And then go apply that running a hedge fund for 6 years with the guy who, was one of the more brilliant guys at Fidelity. I've had a lot of luck, running into the right people along the way. So I would say this, I'm smart enough, but if I can do it, I know everyone says this, anybody can learn to do it. I'm not off the chart brilliant, but smart enough to understand and, determined and patient enough to do the work. But I will also say nobody is immune to having a tough time when the market is great. I've watched Bill O'Neill struggle and how he handled it to come out of a tough time. I got a little bit squirrely, let's say, at the end of last year and shaved a solid 20% or so off the top of my account. In my opinion, underperformed on in a market that I should have done much better in last year. However, over time, if you do get the rules down and you have the time and patience to be able to do it, the numbers have worked out well for me, and hence I'm still able to survive in the business, knock on wood.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
When the system got you out of the market back in December, you said, do you scale out of the market, or is it all in or all out?
Nope. I absolutely. There are times where, there's very, very rarely a time where I'll just push the button and sell everything. I used to do that, and I learned that rarely does. I usually wind up sorry from doing that. So I have a rule. Don't buy a stock unless you know exactly where your sell stop is and why. And that means if you're wrong and if you're right. You want to have an idea of where you're selling on the way up and if you're wrong on the way down. I tend to use moving averages. My goal used to be like Bill, because I've watched him, and David Feldman, who's still holding a giant position in Apple from 2010. And even with him holding my hand, I can't do it, right? So there's a difference there. Whereas me, I'm looking at the personality of a stock. If I notice the stock 9 times out of 10, when it breaks its 10-day on big volume, goes to that 21 or 23. And then when it breaks the 21, it goes to the 50. I'm usually selling at least a third, if not half, depending on where that stock is, right? How much has it run? How far extended? Is it above its short-term moving averages? So on and so forth. So where I used to try and hang on to a position as long as it was still profitable above the 50-day moving average. In my old age, I have changed that to the 21-day simple, unless it's a stock that shows me it respects the 23 exponential, right? Which is just a hair below, but it's very personality based. So yeah, I'm scaling out. I'm not using a 5 or an 8 day, moving average, which some people might. So I'm usually between the 10 and 21. I get a break of the 21. If it's super huge, and let's say it's broken other areas, maybe I'll get out. But 9 times out of 10, when a stock breaks a moving average, I let it be for that day. And then the very next day, if it undercuts the low from the prior day, I just get out intraday. Otherwise, I'm usually waiting till the end of the day to enforce sell stops, because in a bull market, a lot of times you'll get that last 5-10 minutes of the day that just saves everything. So I'm always trying to give the trend the benefit of the doubt. So in general, unless it's like one of those big breaks, I wait for the second day. And if it undercuts the low from the first break, I'm out intraday. I don't wait for the end of the day, because I don't want it to break and then wind up at the 50-day. Otherwise, I want it to, as long as it doesn't undercut the low of that close, right? So let's say we close below the 21-day today on a stock. I'm not selling the remainder of my position. Let's say I've already sold half below the 10. And I treat all the moving averages like this. I'm just using the 21 as the example. The second day, as long as it doesn't force me out, undercutting the low of the close below. And you'd be surprised in a great market how many times this rule keeps me in a stock, giving it a chance to close one day below and then using the low of that day as my stop for the rest of the position. It's amazing how many times that keeps me in a great stock, like by a hair.
So, given how long the Can Slim method has been around for many decades, wouldn't it lose effectiveness over time because so many traders know about it?
You would think so, and I think really what it's done is it's made it so you have to. It really requires you to do some observation and making it your own around your personality. And what I mean by that is there are guys that are going to be able to trade the service nows of the world while and because of their personality, the way they view things, which is going to be totally different than me, and they'll be able to make a fortune doing that. I may use it a different way. So I would say in the beginning where you could just kind of follow the rules of the book, honestly, and get away with buying the bridesmaids, let's say, right? As they broke out because it was a leading stock that did a similar thing. I think the easy got washed out. But if you start to watch and understand a stock's personality, the breakouts all still work. Like I've watched and wondered, like the ones I will look and see, okay, this stock broke out and failed twice or three times, and it finally worked on the third or fourth time. And I'm constantly looking, going back to see after it broke out, did any of the pullbacks come to that 7 to 8%? And I can't. So many times it doesn't. Now, so technically that means you could still be holding that stock. Now, whether you should still be holding it is a different story, because while that stock may still take another failed breakout or two before it finally works, what if it takes 9 weeks and you're missing everything else that's working now, right? So there's a lot of that. Also, it does force you. So there is that, proactive, okay, I bought this stock, I expected it to do this, it's not working, it's time to move on, right? So again, a lot of it does take time and experience. Bill would tell you it take you at least 3 years to really get it down and do well. I would say it takes getting a few cycles under you. I can't tell you how many times I heard the best guys tell I'd ask a question and they tell me, just watch the leaders. And that always feels like just a brush off. Okay, yeah, great. I'll watch the leaders. Okay, let me give you now, right? That kind of thing. Mm-hmm. But it really does come down to, what do they mean by that? Because the real leaders, there's far and few between of the real leaders. When I'm looking at what I would consider a big group of stocks, I don't know, I think if I look at the entire database right now, I don't know, it's around 11 or 12,000 stocks, let's say, at any given time on a really strong market that's really super broad. My list is about 200 stocks out of close to 12,000, right?
Okay, so this is a good follow-up question here.
Mm-hmm.
How often, or do you know of people who will say, well, 5 or 6 of the 7 were met by these stocks, and so that should be enough? Or do you just simply patiently wait until you find all 7 criteria?
Oh, no. So I will absolutely. So with time, right, I will anticipate. And so this is all part of it. So let's say I see XYZ quantum stock breaking out, right? Now I'm looking at I'm just making this up, the quantum stock group, and I see the next 5 or 6 top RS stocks with some earnings that are, have a reasonable price and liquidity to them, are forming similar patterns, appear to be showing signs of accumulation, high relative strength. And let's say it doesn't quite have the earnings yet, but it does seem to be a new, young, growing company, and it does have the story. And the analysts aren't looking for it to earn money until the middle of 2026. That's still fine enough by me. If I can look at it and go, okay, this looks like it has a very similar, reasonable, sound story. Their revenues are XYZ on a relative, and that sort of thing. And I will absolutely in it. And wow, look at this pattern. It's nice and tight here. It's doing all, so I have very specific things that we look for that indicate accumulation that's a big part of what I was getting to. Buying breakouts, textbook breakouts is a very difficult thing to make happen now. Yeah, that I think I'm not going to tell you the effectiveness of being able to just get away with buying a breakout and having immediate success is much lower now than it used to be. However, those breakouts still seem to ultimately work. They just not as quickly for for one reason or another. So it takes a lot of that's why with the time I'd say 3, even 5 years, a couple cycles to get a feel for the different personalities of stocks, how rotation looks as a market is putting in a bottom, as it's going through a powerful uptrend, as it's topping. Really, that is what's helped me more than anything else. The rote process, because I'm very lucky. I love it. So I consider myself very lucky that I wake up, I do it on the weekends as well. Saturdays and Sundays, I'm running screens. I'm constantly tabbing through charts. The good ones I'm adding to a list. I'm drawing alerts. The bad ones I'm taking off my list. And by the nature of that process, it's impossible for me not to know where the money's flowing and going, right? So when money's coming into quantum and gold and flowing out of what I can see it. So today when money's coming into, you can pull them up, look at the building stocks and some of the software as it tries to shape up off the bottom with the IWM and I guess like Bitcoin today and the gold stocks. So I immediately go and look, maybe we've got, it looks like a double bottom going in. Do we have what looks like a legit undercut and rally could be going on in the software sector? And then I might go into the software sector and break it down by industry groups, right? Security software, database software, whatever it is, and see what are the top performing or the highest relative strength stocks in those groups doing. And I'm constantly going through, that's all I do all day is make lists and if you saw the amount of alerts that I set and reset on a daily basis, you'd wonder how they didn't put me in a loony bin 25 years.
Well, great. Ross, well, to wrap things up, anything you've been working on lately, kind of outside of the direct trading that you've been talking about?
We're constantly working on content at Trader Lion, Deep View related is ours. So we've got some new releases coming out over the first quarter, Deep View. That should be awesome if you're, into the charting and screening thing. And then very related to this, I started and I have put on hold for the time being because things have gotten busy, but I am working on a CanSlim modernized course, which is going to be all of everything that I do that I've noticed that I have found different and new. So everything that I employ that I find like we're discussing that still works now, and then all the stuff that I have added to make it work better for me.
Thank you, Ross, for coming on Chat with Traders.
Oh, dude, thanks for having me. I really appreciate you.
Yeah, great. How can our listeners get in touch with you?
My email would work, ross@traderlion.com. And, either of the websites, Trader Lion or Deep View. If you have questions about Deep View, if you send it to hello@deepview, I'll wind up seeing that as well. So hello@deepview.com or ross@traderlion.com, and I will see your message.
Fantastic. Thanks for coming on the show.
All right. Thank you so much, Ian.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
You can't focus too much on what you don't and never may understand. Yeah, lots of things are going to be said, lots of things are going to happen, but is that going to make you money? Not necessarily. There's lots of things happening in the world, and there's lots of things happening throughout trading, and I've seen it change in front of my very eyes. I've seen the media and its attitude to how it presents data change. Everything you see, doesn't have to necessarily be taken a pinch of salt, but it's not necessarily there to make you money. So the best thing you can do as a trader or a retail trader is kind of fade out a little bit of this news. Look at the screens. What are the markets telling you? How are they moving? Don't get too pigeonholed into listening that some hedge fund manager is going to tell you what the next big stock is going to be, because they're all out there to make money. It's a tough, hard game. And it's like I said, back on the floor, no trader is going to tell you exactly what they do because that's their edge. So be very kind of wary about what you're being told and expecting it to give you instant results, because they don't. The biggest things that are going to kind of move the markets are the unexpected things. But there are so few unexpected things because of that underlying narrative. And the big thing that will come, you probably miss it because it will be so big and so quick, you haven't had time to prepare.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Yeah, we're back on Chat with Traders. Thank you, all of you listening from all over the world. That's just so cool. This is episode 295. I'm Tessa Dow, and my co-host is Ian Cox, and we're hoping that you're doing great in every way. Now, I would love to get you straight to Ian's interview with our next guest today. His name is Steve Ruffley. He trained as a professional and now defines himself as a pro retail trader. He's now spent nearly half his life honing his craft in the market, spanning a couple of decades, making the largest amount of money that he can from the least amount of time spent day trading, such as achieving 5-figure gains in a couple of minutes. Steve trades big size with 3 trade types and 2 entry styles, which we'll hear more about as we get into the chat. Having been a trader from the trading floor in a highly competitive environment to then switching over to trading as a retail trader, a professional retail trader, makes it a very interesting perspective. Steve's entrance into trading wasn't planned. It was a mix of ambition, timing, and the right connections. Leaving university early, he took a finance job moving to Gibraltar in the southern tip of Spain, where he met traders running a new trading floor. Intrigued, he joined their intense graduate program, enduring the 6 weeks of brutal tests where failure meant dismissal. The trading floor itself was an adrenaline-fueled world, rows of screens, high-stakes trades, and the culture of both camaraderie and competition. Definitely, this experience had to have shaped his trading mindset, philosophy, and technique, where risk is not a dirty word, and size and speed are essential. Steve's also a trading mentor and author of his latest book called The Pro Retail Trader. By the way, this wasn't planned, but we included a little bonus snippet of a short conversation with Steve after the interview for those interested in hanging around just for a couple minutes more. So without further ado, ladies and gentlemen, we are so pleased to present Steve Ruffley, currently based in New Zealand.
Well, Steve, I'd like to welcome you to Chat with Traders.
Thank you very much.
Well, where are you now, and where did you grow up?
Well, I'm now in New Zealand, about as far away from I grew up, which is Bolton in the north of England. You may or may not have heard of it.
And so tell us about you kind of growing up in Bolton, and kind of how did you first get interested in the financial markets?
Sure. Okay. Yeah, I mean, a fairly typical upbringing in Bolton. It's the biggest town in Europe. It can't be a city because something that happened in the past. I don't know. I wasn't really kind of big into history at school. But basically, my kind of route into finance, I guess, was I went to university for a couple of weeks to study economics. And I wasn't particularly interested or particularly connecting to what was being said. And I spoke to the lecturer at the time, and he basically said, well, you'll never get a good job. You'll never do anything without a degree. I kind of left, and to prove him wrong, my first job was for PricewaterhouseCoopers as a graduate, funnily enough. And I was basically started placing investments for high net worth individuals. So that's how I got to know a little bit about the finance world. And yeah, that kind of piqued my interest. From there, really, again, bizarrely as my life does, I had the opportunity to live in Gibraltar, which is the southern tip of Spain. And I was in Gibraltar for a while, and I was down at one of the ports, Port of Banús, quite famous down there, and well known for its luxury, its yachts, its fancy cars. And I just bumped into these guys, and yeah, that's what they did, you know. And after general chat, they said, "Well, we're traders. We've started a trading floor in Gibraltar." I'm like, "Well, that seems like something I could be interested in." So basically, went for an interview, and yeah, I was one of the original first Revco grads. It turned out to be, and that's really how my trading career started.
So what year was this?
Well, it's gone way back. It's probably early 2000s, 2004 maybe.
Oh, okay. So this is after the .com crash. Is when
Yeah. It's before the trading floors and all that kind of stuff. Yeah, I'm still a relative, you know, kind of newbie, I guess, in kind of trading terms. You know, 20 odd years. You know, it's not that long, I guess, compared to some other people we've had on the show.
And so, what kind of describe for us? What did you first do at this group?
Well, it's very interesting actually, because basically we're all based in Gibraltar, so we got sent over as part of a kind of an international thing with other people of offices around the world, and we all basically camped out in Earl's Court in London. We had a big flat. I guess in some ways you could say it was a little bit like The Apprentice. So we went to the Liverpool Street offices every day. There was a lot of intense training and you know, kind of tests, and you know, to kind of, you know, prove you could perform under pressure. And they said, you know, if you didn't pass milestones, you know, daily, weekly milestones, you were fired, and people were. So it was a little bit brutal. So yeah, we had about 6 weeks of that, and yeah, I passed. And then the kind of the prize or the goal of it was to actually be backed by Revco and be a trader on the floor. So my first experience of kind of floor trading was when they took us onto the live floor. And it was like something I'd never seen. You know, you've got rows and rows of people, you know, guys with 8, 10, 12 screens. This place had its own deli. It had its own arcade room.
Mm-hmm.
It was just like an atmosphere I'd never seen. It was, you know, for a boy from Bolton, it was pretty unbelievable. So, yeah, when you actually get to sit down on your own desk and you're around, you know, some legends. There was Andy Preston sat on my floor back at the time, Braveheart, you know, so some big names, people making huge amounts of money. And yeah, so that was basically it. That was my introduction to trading, and it seems like a million years ago, and it's so different to what I do now. Obviously, being sat home with my own screens in my own home office, but yeah, great experience, and something that kind of made me not the trader I am, because you know I do see a big distinction between the pro world and, you know, myself as a pro retail trader, but it certainly gave you all the ambition, should I say, to follow this through and to see where it could really take you. So yeah, great time, great experience.
So you sat next to traders on your left and right that were trading, and is that right?
Absolutely, you were in rows and rows. Yeah. So yeah, I mean, it was you know, again, it's when you're the newbie just coming in, you know, you don't get to talk to the big guys straight away, but obviously, you know, kind of being on the floor, socializing, you get to know people. Traders like to gossip. But everyone kind of quickly knew pretty soon who the big guys were, and it's aspirational, but also, you know, a little bit intimidating. So yeah, I mean, talking about a baptism of fire, that was one way to kind of to put it.
So did the big guys share any of the trades that they're doing, and was it common for certain traders to piggyback off of other traders and simply copy, or was that even allowed?
I mean, sure. I mean, listen, it's a bit of a boys' club, and it's, you know, a bit of a hierarchy. this is the thing, everyone, you sit next to somebody, and as a newbie, the first thing you ask is like, what are you looking at? What are you going to trade? And these guys have been doing it for years, and they'll share a little bit of information, a little bit of knowledge. Traders, they're just blokes, they love a good gossip. But, all we talked about was, kind of what the markets was doing and money. It all came back to money. I know that's a faux pas thing to talk about money in trading, but that's what we're all sat there for. We're all sat there, guys were going out in the lunch breaks, buying a Rolex when they had a good day. It's not Wolf of Wall Street stuff. That's a whole, kind of different side of it. But yeah, there's a lot of guys there that were there to make money. And, people that, you wouldn't necessarily think are traders. You wouldn't be able to spot a trader if you walk past them on the street. You really wouldn't, they just look like normal blokes. And they were all blokes. I think there was maybe one woman on the floor in the entire time I was on there. So it was a very male environment, very bravado. And yeah, information was passed around and shared, but listen, nobody's going to give you their edge. Nobody's going to sit there and tell you what to do. And that was the whole point of the whole kind of graduate course. It's like they will teach you all you need to know about maybe charting, all you need to know about, the market structure, products, etc. But they don't tell you how to make money. And that's something I didn't get originally. It's kind of, you either have something in you that you can make money or you don't. And they were that brutal. Like if you couldn't make it, you just burnt out. You just went away. You didn't make the money. So it was quite an interesting, I don't know if you call it experiment, or what you call it. It's quite an interesting way of finding, out who could actually do it when it really mattered. So yeah, quite an interesting time.
Why wouldn't they teach you how to make money? I mean, don't they want you all to succeed? Isn't it to their benefit?
I don't know. You'd have to ask them.
Oh,
at the end of the day, that was what they gave you, and it's we've give you all I can. We're going to back you. You can have as much size as you want, and do it. It's like all these things. It's just a numbers game. People, can press the button to trade. And have a multitude of reasons for doing it, your technicals, your fundamentals. But it's the guys that press the button that, when it counts, with the right kind of size when it counts, and makes those big numbers. And that's either in you or it isn't. And it's almost when you, I have described it in the past, when you meet people that have it, you can't describe it in air quotes, but somebody has that something present about them. They trust their gut, they're confident, but they're not arrogant. Okay. So that's what that kind of environment brings out. You can either do it or you can't. And some people are born with it, I believe, and we've all met those people, I presume. And some people have to manufacture it. I don't necessarily think I'm arrogant enough, rightly so, to say that I was born with it, but I had something, but I had to create my it over time. And yeah, my only goal was to use as much size as possible and to make those big wins. And, that's really, what trading on the floor perspective is all about. Everyone's there to grind, to make money day to day. But you have to remember there's such high costs in pro trading that, you have to be making money, sizable amounts of money all the time. Otherwise, you can work for a year, and by the time you paid your tax, you're coming out with nothing. So it's not something, to be taken lightly. And you have to remember, as a trader, as a pro trader, there's no wage. You don't get paid. So that's why the whole mentality of the floor traders are, you're there to make money, you're there to use size, trade the opportunities when they arise. You're there to be fastest finger first at the time, back in the day. You're there to listen to the big news events and the big data events, because that's where you're going to make your money. And listen, every single trader, professional trader I know, has a big win story. Every single one. They've done it when it counted.
So they all have a big story to tell on their wins. Do they share about their losses too, or?
Yeah, absolutely. Generally, you see the losses. Back in the day, it was a different kind of vibe. A lot of floor traders had come to the screens, so you'd see computer mice flying across the room, people standing up and shouting and swearing. It's a high pressure environment, and that's what they were used to. But yeah, people were never shy about saying the losses. But again, it's communicated through people that trusted each other. It's not like you have to stand up and say, I lost this today. At the end of the day, the way trading is on the floor, and as it was, your own business. You're literally your own business, your own entity within, the kind of the framework of the house. So, yeah, your business is your business. You want to tell people you had a good day, tell them. Maybe you told them a bad day, tell them. If you don't, you don't. like most things, it's generally the quiet guy sat in the corner that's trading thousands of lots and not making a sound. It's the people at the control of emotions. But, the old guys from the floor and that kind of stuff, they had a lot of emotions. Didn't say they weren't making money. Sometimes they were making money and still angry about it. It's just there's a very different time back when I started. I think the transition through to more screen trading has led to a different type of trader over the years.
So how long were you there, and what were some of the things? I mean, how was the process of learning while you were there, and what were a few key takeaways? You mentioned size was one of them.
Yeah, I mean, size really is the ultimate aim. But size, like leverage, like all things, is a dual-edged sword. So there wasn't really a lot of mentoring, a lot of help, a lot of support, to be honest. It was just generally who you became friends with. I became friends with the risk manager, and he taught me some things. He saw a different side of, obviously, the other side of what the traders were doing. And you get information where you can. I mean, at the end of the day, as I say, it's just the same for any trader. I just did it in a more kind of concentrated stint. Everybody likes to think if they know a bit more about technical analysis, or they know about the fundamental side. If they just knew a bit more knowledge, then they'd be able to trade. But as I said before, what you have to learn is the psychology of understanding yourself, understanding, what's important to you, what gives you the confidence and commitment to put that trade on. And everyone starts off with small size. But again, you were discouraged from starting from very small size, or even using demo accounts, simulators that were available, because you can't attach that emotion to it. So really, as I say, you're pretty much left to your own devices. And, it was down to you to pick knowledge from other traders where you could, or just to kind of sit there, watch price action, and just to kind of test it out. I mean, the best lesson in trading for anybody is the more you trade, the more you know about yourself. Everyone thinks there's some magic formula, or some book, or some webinar, or some course. But to get to that next level of when you can press the button and trade and make money and do that, consistently, and have those larger wins and also manage the losses, it's all done through experience. So it was just a lot of that. It was a lot of that, just screen time. And that was it, really. I got to a certain level, and, unfortunately, it's kind of, I'm not from money or anything. It's kind of after a year or so of trading, you're thinking, well, I'm paying my desk fees. I've had like £10,000 days. And, at the end of the kind of year, you're drawing out a couple of thousand to live off. It's like, well, this is not the kind of life I expected from a trader. So that was kind of a turning point for me. You have to remember, when I started this grad scheme, to be able to buy yourself out of that grad scheme was £250,000. So we're talking 20 years ago. So that's a sizable amount. So you had to make that in order to pay Revco back to then go on a different split, or maybe back yourself. So really, after a year or so of doing this and not kind of generating enough money to kind of get by and stay in the game, I wasn't being able to draw enough money that made what I saw as my time investment pay. So I had to talk to the guys and said, it just isn't working for me. And they said, well, you get on well with the risk manager. Why don't you work in the risk department and, see what that's all about? I was like, well, yeah. I mean, I'm still in trading. I'm still on the floor as such. And so I spent just over a year, actually, in the kind of risk room. And that's really when I knew everybody knows about the size element and the money element and what can be made. But when you actually see it in real time, I'm not just talking about one or two traders, you get to see what every trader does in real time. So instead of your trading screens, you have big screens full of traders' P&Ls. And your job is to manage those P&Ls and to understand what the market's doing, and, where the risk is for the house, where the risk is for the trader. So when you spend your year or so looking at multiple accounts over anything from a non-farm payrolls to an interest rate decision, you get to see patterns. And really, patterns, the more I looked into, I'm a big fan of things like Fibonacci, but that's just one thing. I'm a big fan of seeing patterns in everything. When you see patterns around activity, patterns around movement, patterns around how traders enter and exit trades, also the kind of correlation between, the severity of the event or the importance and the size used, the time they stay in trades, I started put together my own framework of what would happen if I was to go back to trading, because that was always my ultimate aim. Nobody wants to be a risk manager. It's the most thankless task.
Why is that? And what being a risk manager there for a year, learning what you learned, did it make you more conservative about risk or more appreciate risk?
No. Risk
No.
in the professional world, is not a dirty word. You are there to risk. That is your job, to risk. Calculated risk to make money. Retail on the other side, you're told all sorts of levels and rules, all completely constricted. Stick to this, stick to that, conserve capital. Okay? In the pro world, you are there to make money. So all I saw was a load of guys making money. And my experience of risk was, you have to be a fairly, which I am, affable guy. You have to be shouted at. But when you ring somebody up, it's never for good news. When you ring somebody up on the floor, it's always for bad news, to be stopped out. The only times traders like you, when they knock on the door and politely ask if they can have 1,000 lot limits in the bund, just in case something happens, then you're all right. So yeah, the connotation is that the risk is negative for traders, as in the risk department, because they will stop them trading to protect their capital, which is a good thing. And that's the thing, retail traders, I guess, don't necessarily have. You have to be your own risk manager. It's your own money. You can do whatever you want. But on the floor, I guess you split into two types of traders: own account traders and back traders. So the back traders are backed by their house, so they have different risk parameters. And this is always money. It's never a percentage of account like you're taught. It's never 1 or 2% of your capital. It's like a daily stop. It's like, right, you're 1,000 down in the morning. That was bad. Okay. So you've got another £1,000 in the afternoon to make it back. You can't trade till the afternoon, and that's it. That's how the risk worked. So it's nothing to do with how retail think, and it's more to do with you being able to understand what that trader's done in the past, what you can do in the future. And, many a times, traders would lose in the morning, end up winning in the afternoon, but it's having that somebody else outside. And obviously it's there for a reason. It's someone outside of the floor, outside of you, that says, and you've got to be very tactful. And sometimes I got this wrong. I got shouted at. And that's fine. This is how you kind of you figure things out for yourself, and how you kind of get through and grow and understand what traders are going through. But yeah, plenty of people that kind of would lose in the morning, then win in the afternoon, or were winning in the afternoon, and it looked like they were starting to lose money, and sides up and try too hard. So you go and have a word and say, well, that's a pretty good day. You're up X amount. Maybe you should call it a day. And it's having that external influence. And it's not to say I've got more experience. I see what everyone else is doing. And, you say, maybe that's enough for today. And I think that's something that, really is missing from the kind of retail side, and just guys doing it on their own. Who have they got to talk to? Who's there? You have to do it for yourself. So having that kind of risk manager experience, mentality, and that kind of stuff, it's something that brought something else to my trading. And, as I say, a lot of traders, even, big traders on the floor, they can't go into the risk room. You're not allowed. You're not allowed to see other people's P&Ls. So, I got an insight into what people did that many, many, many traders will never get to see. And I'm not saying that, I saw the matrix and cracked the code or anything. I just saw what was actually achievable and people really, really doing it. And, some of the kind of aspects and key points that I took were speed and size. And that really, hit home with me. And that was something that when I was to go back to trading, that was my aim. My ultimate aim was speed and size.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? or sat on the sidelines because your account balance felt too small to matter. Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
I see. So working in the risk department actually taught you how important it is to take on more risk, that the big players who made the big money actually took on size. Is that accurate?
Absolutely, right at the right time. You know,
Mm-hmm.
you know, when you see an opportunity and everything's aligned, and that the floors were great for that, because it was almost like you'd have a hush and then a buzz. Like people would know when things were going on. What other traders traded, so you'd hear like maybe them say something or shout, and it'd be like, oh well, that's obviously he's long the bund and it's going down. What's that doing to my market? And there was a lot of kind of, obviously these floors existed for a reason, to kind of create that buzz, to create that kind of sense of urgency and bravado, and to push you to do better. And that works to a certain point. But what I found is, after we will continue on without my story, is it can be a little bit counterproductive. Always being in that pressurized environment where you're trying to be the absolute best. It can be disheartening.
So you mentioned about retail traders a couple times. In
Sure.
your latest book, you talk about the common traits of retail traders. Could you go into that for us?
The whole point about the retail market and retail traders is there's a lot of people that say the pro word, and they kind of bash it around like it's the answer to everything. Pro is just a mentality. Pro means you do it for a living and make money from it. And I think a lot of retail traders fall into this category of an endless doom loop of trying to learn. And that's all they do. They try to learn more technical analysis. They try to understand all the different parts of the fundamental analysis that makes up the market. And they don't progress because they don't get the confidence to press the button when it matters, because everything seems to constantly conflict. So traders, the retail traders, will try and get that consistency. That's all traders, that I've mentored and kind of worked with over the years try to do, is get that consistency. And when they get that consistency, they'll size up. Okay, there's no easy time to size up. There's no easy time to kind of make that next psychological step. You just have to do it, and that will be different for every trader, every trader's personality. But on the trading journey, as I call it, every trader, the professionals, the retail, the good, the bad, the ugly, they will go on this journey. They will hit different points at different times, but it will still be the same journey for everyone until you actually get into a point where you're confident to press the button and do it consistently for yourself. So the main retail kind of traits that I see is that people lack the ability to give them permission to know what they need to do anyway. Everyone can say, this is what I'm going to do. This is what they say my plan is. But very few people actually follow it through. And very few people follow it through with a plan that actually relates back to money. So this is the other thing why I always talk about money. It's all very well saying that, yeah, I'm consistent. I made 10 winning trades this week and I've made $100. Okay, well, $100 a week, $400, $4.5 grand a year. Is that worth 10 hours a day sat at your screen? No. So you've got to kind of make these things worthwhile. And your time's important. Time's much more important to me these days than money. And it always has been since I click air quotes got it. So that's my balance, from my kind of side, because I do class myself as a retail trader because I trade in a retail platform. I may be the pro level of money, I guess, to some extent, but I'm still a pro trader. So what I'm always doing is balancing out, do I need to be sat in front of the screen trading, or could I be doing something else? When I am sat in front of the screens, it's for a reason. I'm not sat there necessarily waiting for something to happen. I have alerts. I have, things set up on my charts. My office is always open. I'm generally around the house or nearby. So I can go back to the screen when I need to trade and do something. And when I do, it will be, for whatever reason, and it will be degree of size and to make a degree of money. I'm not just clicking the button for the fun of it or for the sake of it or just to kind of be in the market. I'm purely there to make money. And that's really what I kind of get confused and concerned with the retail traders, is because they want to make the money, but they're not doing the right things in order to do it.
So you said in your book that you try to identify one big trade a month. Could you break that down for us? What are we looking for when we're looking for the big trade for the month?
Well, I mean, the big trade is, you're either looking, for something to shift, the narrative that's going through the market, or something to correct. So, I mean, all the big trade means to me, and it's different because I only have 3 trade types and 2 entries. So the big trade for me is a time thing. All my 3 trade types revolve around time. I've got a scalp that lasts up to 15 minutes, an average trade which lasts up to 2 hours, and a day trade that lasts up to 8 hours. So a big trade for me, a big trade means staying in a trade for a longer amount of time, which can be up to 8 hours. So some of my trades have been minutes, seconds even. So minutes, hours are a long time for me in trading. I'm predominantly a scalper. But if I'm looking for a big trade, something to break, something to break out of the trend, and that can be triggered by, a piece of data, it can be triggered by a comment, or it could just be triggered that I will want to leave some money on the table. But this is important. So when I'm a scalper, I try and take the profit the first time it is offered to me. Okay, so I'm trying to take money out of the market quickly and not leave it on the table. So when you do an average trade and you bring the element of time in, especially a day trade, your P&L will fluctuate. It will go up and down. So I don't like leaving money on the table. So if you're leaving something and you think it's worth holding the time risk, you're going to be seeing that P&L fluctuate and going down, which is counterintuitive for me. But the big trades, I generally use smaller size on, so I can make bigger wins with, I guess, less perceived risk by letting time come into it. Because generally, the shorter the time I'm in for a trade, the bigger size I'm using to compensate for the small amount of time in the market. So what you're looking for is a time element. I'm looking for the market to make a directional shift. And it's the absolute high or low. It's from the current trend. It's moving out of what it's doing. And this can be anything. It can be, a reaction to data. It can be a reaction to something that's said. It could just be profit taking for the big players. At the end of the day, things will range and they will move. And that's, kind of good for scalping. And then when markets break out, sometimes you have to add the extra element of time and position yourself in a different way to benefit from bigger pip tick movements.
So you mentioned the time element. So these are tied again to some kind of news release that you're anticipating some kind of reaction to that may come around periodically, but it's not necessarily that common. I mean, you're waiting for these announcements, correct?
Well, I mean, you're waiting for an announcement or a technical setup. I mean, again, I think, people rely too much on this idea that, the fundamentals will give you a big opportunity. I've traded plenty of big fundamental events and made sizable amounts of money, but these are unexpected events. These are not what the market is expecting. Okay. So if you think you're going to trade the non-farm payroll, see a piece of data, that's actually quite a dangerous piece of data to trade, because the market in the short term can do the exact opposite of what you think. So what you're really trying to do, and that's what any trader is trying to do, is seeing how the narrative, how the market has built up its sentiment, what it's thinking, and will it continue or will it reverse? That's all I'm ever really thinking. And all I'm ever thinking is this a short opportunity to scalp within that range or that breakout? Because again, I've got 2 different entry types. I either follow the market or I fade what I see. So is this a 15-minute opportunity of volatility? Is it a 2-hour opportunity of volatility? Or is it a day trade opportunity where the market will move, consolidate, and then continue? Because that's the biggest trade in pip-wise you're going to get. When something consolidates, it's confirmation, and then it continues. Because when I'm scalping, I'm never looking for confirmation. I'm just looking for price action and the market to get to levels that I set. And I incrementally increase my size to have more risk and to have more short-term pain in order for the market to pull back quickly. So it's everything I do is based around looking for types of movement and volatility and how I can apply my framework in time work in a time frame to what's happening in the market.
So how do you set your targets, and how do you try to vary them depending on the type of news and the type of events? How does that work?
I mean, everything revolves around the size of the account that I'm trading. I'm not like normal traders. I will trade multiple accounts. I have different reasons for doing that. So when I'm trading, accounts where I've had wins, and I'm on a good streak, I might try to do more, kind of average trades or day trades, and then leave the scalping to another account to build that up. So I'm always looking for certain types of movement, and it's either very, very quick movement that breaks out of the range. And that could be from something that said, anything can move the markets. Look at Trump right now. He's back another 4 years. He didn't mention crypto in his inauguration speak, and it dropped. Now he signed an executive order just today, and it went up, and then it dropped. So that's things that can now change the market sentiment in the short term, and can provide short-term opportunities. But I mean, you either have to be sat there waiting for these events, or sat in front of the screens waiting for Trump to say things, or you can trade it more from a technical perspective, where it's not necessarily the levels are going to be hit. What I set my kind of alerts for is how quickly levels are hit, because that indicates the volatility. And I'm a very visual trader, and I trade visual things, visual patterns, as I said before. And when I'm trading, I know intrinsically how much size I'm going to use based upon the trade type. And I've got a good idea, because I've done thousands and thousands of scalps, what I can make of particular types of movement. And it's always monetary. So it's like, well, that's a quick scalp, couple of minutes. I might make £10,000, $10,000, whatever. That's fine. I have an idea of what I can do. Now, the markets move so quickly, and this comes back to the kind of the pro side of the days on the floor, that, you used to speed. That's what you pay for, direct market access. You can lead on the bid and offer. You could be in and out. You can't necessarily be as quick as you can on a retail side, but there is an element of that. And that's why I scale into positions quickly. And I have almost like I think I'll call it in the book, a muscle memory. I'm just so used to seeing something and clicking and being able to change my size on the keyboard quickly to be able to get in. And that's my edge. That's my element, of being able to take short-term pain and to think extremely quickly, is that I know the outcome's going to be an amount of money I know I don't want to lose, and I'm out, because I have one simple close all. I'm in or I'm out, for profit or loss. And then when a profit comes on side, I, do things that, again, when you talk to other traders or the experts will say, never look at your P&L. Well, you have to look at your P&L. It's your P&L. The big thing retail traders don't understand is when you're trading retail, you're not trading directly in the market. You're trading simulated markets. So what I see in my P&L can be there 1 second and gone the next. So when I'm scalping, I might see big numbers, and I have to be quick to press that button, because that can flip back to a break even or a negative position, in a matter of seconds. So what you're seeing on a retail perspective is not what you'd see if you're trading on a TT screen, direct market access, for instance. So there's lots of nuances that I've picked up through trading over the years that, do distinctly separate the way you can professionally trade and the way you can trade on a retail platform.
Speaking of narrative, you mentioned in your book that you used to believe that narrative was 80%, or trading was 80% technical, 20% fundamentals, and now it's shifted to more to 50-50. Why is that? If you could go into that.
Absolutely. I mean, over the last 10 years, obviously I've had enough screen time, and, I watch the news like everybody else. I think, we can't not listen to the news, it seems, these days. And I think, what we've seen after, big events like COVID, etc., and, what we're coming to now, the climate change, net zero, things have been on for a long time. There's been a lot of narrative built up that, there's a problem and there's a fix. Okay. And you're given information, and then you're meant to agree with the narrative because the fix, has to be better than the problem. And what I've seen, that's news. We all have to live with that. What can we do? Not listen to the news anymore. Basically, just to shut ourselves off. We can't do that. But what I've seen, especially in the kind of news from the business side or financial side, is there's a narrative building up again. we've got this narrative right now where, the economy is great. It's stock market's making all-time highs. That's great. Well, number one, the stock market's not the economy. So there's lots of things building up that I see to kind of bring people in to say, yeah, okay, everything's working. It's good. The stock market's good. But then we're ignoring the jobs, the job revisions, the facts, the non-farm payrolls that are made up of basically part-time jobs. We're not seeing the massive amounts of layoff that's happening in tech. We're not seeing the kind of consolidation of businesses. So when you talk about, the kind of fundamental side, for a pro trader, and again, I'm talking about the institutions and that kind of stuff, they can build their positions and views over a long time, and the narrative seems to support them until the time comes for them to pull, and then the institutions make a lot of money, and the pros and maybe the retail will lose, quite a lot of money. You don't want to go into this stuff too much because it starts to kind of, you get this tinfoil hat mentality where everything's against you, and that there's a big conspiracy. All I know is money makes money, and all I know is I know some rich people, much richer than kind of the Elon Musk type characters, billions and billions and billions, and they know other rich people, and you see it with the media, and you see it with business. Everything's getting consolidated, and rich people talk to rich people. So what I'm saying is, there's, especially again for the retail trader, you can't focus too much on what you don't and never may understand. Yeah, lots of things are going to be said, lots of things are going to happen, but is that going to make you money? Not necessarily. So what I'm a big, kind of believer, and listen, I wrote the book. I didn't have to write the book. I'm fine. I can sit my days trading. That's fine. But I had something to say. I want to kind of, put it on the record that, that there's lots of things happening in the world, and there's lots of things happening throughout trading, and I've seen it change in front of my very eyes. I've seen the media and its attitude to how it presents data change. So I just want people to be prepared that, everything you see, doesn't have to necessarily be taken a pinch of salt, but it's not necessarily there to make you money. So the best thing you can do as a trader or a retail trader is kind of fade out a little bit of this news. Look at the screens. What are the markets telling you? How are they moving? Don't get too pigeonholed into listening that some hedge fund manager is going to tell you what the next big stock's going to be, because they're all out there to make money. It's a tough, hard game. And it's like I said, back on the floor, no trader is going to tell you exactly what they do because that's their edge. So be very kind of wary about what you're being told and expecting it to give you instant results, because they don't. The biggest things that are going to kind of move the markets are the unexpected things. But there are so few unexpected things because of that underlying narrative, and the big thing that will come, you probably miss it because it will be so big and so quick, you haven't had time to prepare. So, I mean, that's what I'm saying. I've seen the kind of shift, and what I've kind of done from my perspective is that, yeah, I'm okay. I could class myself as an economist. I've been a trader for long enough, but, I don't take too much notice of, what the actual data is. Or what it said. I'm much more concerned about how the market reacts. So again, like the non-farm payroll is a great example. It could be a strong, market non-farm, could be a strong market payroll number, but then the market, like the S&P or whatever, the Nasdaq, etc., sells off because it's the narrative is then the economy is very strong, so we don't have to put interest rates down, which net's a negative for stocks. So you can end up, like the technical analysis, have so much on your charts and so many kind of indicators that you get like kind of trading blindness. And the same thing can happen with the fundamental side, is you hear so much that it stops becoming useful to you and it just becomes a distraction. So really, again, for my advice or my kind of, view on this, and I've done it myself, is I'm much less interested in what the actual data is in the narrative or the long-term view. I'm much more interested in what it does to the market. And if you don't know what it's going to do to the market, don't trade it. You can let the market trade for the next 5 minutes and still have an opportunity for a pullback or continuation and still make your pips. At the end of the day, trading is about being right at the right time, not picking the high and the low, not riding, the trend or the trade as long as you can. That's for people that use small size and have to have time. If you can use any kind of reasonable amount of time, 20, 30 pips is enough to make you some good money from a trade. And there's less risk involved, as I see it.
Just for our listeners, 20 or 30 pips is equal to what, 0.2 or 0.3%, or
it depends what you're trading on. From a retail perspective, when you're trading, a pip movement, yeah, you're talking about 20 30 pips on, the kind of whatever instrument you're trading. So it's not necessarily like the futures, you're just actual price increment movements.
In your book, you said, I am an animal when it comes to trading. Tell us about what it's like to be an animal.
Yeah, I mean, as I say, when I'm in the trading zone or I'm trading, a lot of what I saw back in the day and how I saw people trade is everyone likes to think that you can take the emotion out of trading and the emotion out of life. Maybe you take the emotion out of trading with a stop and a take profit. Maybe, you can to a certain degree with investing when you're trading over, kind of months, years, and decades. When you're trading for minutes, seconds, or, very short periods of time, you're going to have some emotions. And, what I try and do is I harness those emotions. And it's a combination of fear, it's a combination of greed, it's a combination of I know whatever I do in that short period of time is going to be uncomfortable, but you're trained to do it. When you see and you put big size into the market, you're paying a spread, and certainly when you're fading the market and you're putting bigger size and you're seeing the bigger numbers add up for your minus P&Ls, you have to be some ways, right there in the moment, completely focused, nothing else can see you, but also be able to take a step outside of your body almost and say, well, you've been here before, you've seen these numbers before, it's nothing new, you've done this hundreds, maybe thousands of times, you just have to ride with it, you have to do it. So the animal side of it just comes with speed, and I can sit there and I can click my mouse, with 50, 60, 100 lots multiple times in quick successions, and I don't hesitate. I don't think about it. I don't fear the outcome. I know the outcome. I'm either going to lose money or I'm going to make money. But that's what makes me an animal. Otherwise, I guess the animal, I don't know really well why I describe it as an animal. Maybe it's because I feel like I'm not normal to the perception of what a trader is or what the perception of people think traders is. Back on the floor, traders were aggressive. They were blokes, they were manly, they, very much all about the bravado. And you have to somehow put that into your personality when you're on the screens because, that doesn't matter. No one else can see you. Nobody else can see what you're doing. Nobody else, is around to pat you on the back or tell you, that was stupid. So you just sat there on your own in your office like I always am. So you've got to almost become something else, become something a bit different than human. I have to be able to do things without fear and, without hesitation and understand that, this is something I've done for a long time and, keep continually doing what I know is right, even though it's uncomfortable for the short time.
What do you think is the biggest lie about trading that most traders accept to be true?
Interesting question. There's certainly a few. I think that the biggest lie that traders are told is that once you're consistent, you can scale up. That really for me is that, it really doesn't work like that. And, scaling up can be anything. The difference between making hundreds in a trade and thousands in a trade consistently, is very tough to get for, especially the retail traders and even some pro traders, that I've managed over the years. But, that difference between getting from thousands to tens of thousands, even I struggle to get into the hundreds of thousands for a trade. There's only so much of a level you can reach and after a period of time want to reach. If I was going to be, the $1 million a trade trader, I'd have done it years back. So there's a level everyone gets to where even you're uncomfortable with the time or the size you have to put in or the person maybe you have to become. So really for me, for the average person, the biggest lie is that if you're just consistent and you follow all the rules, eventually you'll get there. Well, you might eventually get there, but that might take you 10, 15, 20 years. What retail trader or trader's got that time to spend and invest in this? So at some point you have to get outside your comfort zone and start moving up, or otherwise you just run out of interest or you run out of time or you run out of money.
But for traders who are not yet consistent, how do they scale up safely? Or is that even possible?
I mean, scale up obviously can be done gradually. I mean, when I'm mentoring people, generally people come to me and they're trading micro lots or one lots. So the first thing is, well, you just start trading two lots. Not a lot of difference, between one lot and a two lot. And then when you've got maybe a few wins under your belt, maybe try for a 3 lot. Then invariably that first trade is a loser and you go back to square one. So it's all, I mean, the thing is really with that kind of stuff, that's a difficult question to answer because everyone's different. So people have personalities, markets have personalities because of the personalities that trade them. What you have to get into is that it's very hard to change a person's personality. So a personality will have a trading style, be it introvert, be it extrovert, be it risk averse, being very, kind of appetite, for risk. And what you have to try and do is kind of play within people's tolerance for what they think is achievable. And I've always done it the same way with money. You set a target you want to make for a month, and then you work it backwards. Well, what can you then make in a week? What can you make in a day? How many trades you want to do in a day? And then you start to build up, the scale up of the size to reflect the smaller trades. The individual trades that make up your days that make up your weeks that make up your month. Then you can see that you're achieving it. There's no easy way to scale, and there's no easy way to get over that mental hurdle of being able to do it. And the gap between 1, 2, 10 lots is pretty the same. It can be difficult. Once you get over, kind of 100 lot on building positions up to thousands of lots, that's something that takes time and something that I think that's just in you. You have to have believed in yourself or seen something like I have, and you have to want to do it. So my aim, really, I wanted the money for sure, but I needed to see if I could handle the size. I needed to know if I could do it. And that's what pushed me through. I just kept clicking bigger numbers because I knew I had to do it. And I knew if I could do it, there was a future ahead. If I couldn't do it, I didn't see the point in trading. So I forced myself to do it.
Kind of like going to the gym and doing repetitions with weights. With trading, is it similar? We have to put in the reps with trading to get our confidence up so that we can get comfortable with size. We've done it so many times.
Absolutely. I mean, everything's repetition, isn't it? Everything. Anyone can be trained pretty much to do anything. You could train somebody to be a brain surgeon with enough time. Would you want them to operate on you? Probably not. It's the same thing. Do you want someone doing it for the first time that can probably do it, or a doctor that's been proven to do it? It's like everything. I don't have any magic answers. I don't have any universal way of how anyone gets to be me. And I don't ever tell people to be like me. I don't want anyone to trade necessarily like me. They need to find their own path, their own way, and what resonates with them. Make their system, whatever that might consist of, their own. Because owning something and have ownership of it is the only way that you can be truly free in trading. It's your decisions. You live and die by your sword. Keep trying to follow somebody else's system. We all take elements from things. That's just human nature. But your system has to be your system. You have to be able to rely that when your system or your thinking or your methodology in trading, is triggered, you then do something based upon what you have seen.
Mm-hmm, mm-hmm. In your book, you said that managing the onside, offside part of the day trade is the hardest thing for me to do. Could you expand on that?
Yeah, I mean, the day trade, I do find difficult because, as I said, it comes back to this idea of leaving money on the table. So again, I tend not to trade maybe as much size with these types of trades, but then you will build into the position. But then it's a lot of waiting. I have a lot of time to talk yourself out of trades. Now, the less I think in trading, the better my results are. I'm much more kind of click and do. I'm not saying that I have the markets figured out or anything. I don't. I've got my head, to anyone's extent, figured out. So I know when something happens or I'm doing a certain type of trade, I can do something. So when it comes to the day trade, as I say, that involves up to 8 hours of trading, of watching, should I say, mainly. Because once you've got your onside position, now, yeah, sure, I could put a stop in the take profit and leave it. That's just not what I do. So obviously, when I'm trading the day trades, I'm expecting movement. I'm expecting something to happen. Now, it might be initial movement, consolidation, as I said, and then more movement, or it might be a quick movement, a little bit of consolidation, and more. You just don't know. And the thing is, when you're holding positions, I don't put stops in because I'm always watching the markets because something can change. Something can happen. So I'm constantly, monitoring that position, and maybe that comes back down to the risk management days. But my hardest part of the day trade is, continually watching that P&L fluctuate and that constant kind of, doubt that comes into your head. Should I take it now? Or, is it going to go to this level? And yes, it might be easier to put a stop in with a take profit, but that's not how I trade. And I don't want to trade that way. And that's just it is. So yes, it is very difficult for me to do those day trades. And yes, I have made big money from them. And I guess in risk terms, they require a little bit less risk. But I'm much more of a scalper and short term trade. I want to be in the market quickly. I want to take my profit out. And that really comes down to what I've seen on the floor, what I did on the floor. My heart of hearts, I am a scalper. But as the markets, evolve and change, you can't just be one thing, I don't think, anymore. You can't just be one style of trader in one market. You can't, you can. That's fine. But I've found that over time in the last 10 years, by having 3 types of trade that incorporate time, I can trade one of my 8 products and I will get a good opportunity for a day trade every month, plenty of average trades and plenty of opportunities to scalp. And that combined means that, statistically, that I will make the money that I need to over the year.
In your book, you say that 80% of your trades are shorts. Why is this? And is it challenging to find trades in a rising bull market?
Yeah, I mean, again, this is the thing. What I like to do is to see the markets spike and get those quick pullbacks. So you'll see a lot of spikes and you'll see a lot of these kind of big individual candles, but they won't be there for very long. So it's not for everyone. And the thing is, you see a lot of them, and I see a lot on the kind of smaller time frames, maybe the 5 and the 15 minute. And what you'll see is when you generally look at the hourlies, you'll see the wicks left. But what I see is whatever those kind of moves are, and yes, we've been a bull market in pretty much everything, haven't we? Everything's at record highs. But you're going to see profit taking. You're going to see the market pull back. When you're only looking for small amounts of movement, like I am, you identify these moves that seemingly will come out of nowhere, and you can short them with big size, and you just take a small percentage of that move, and that's what I like to do. I mean, the thing is, I do have a favorite trade type, and that relies on speed. It relies on my animalness, my aggression, and that's what I look out for the most. Because although it's a short period of uncomfortableness or getting in that mindset of trading, I can do that, maybe a couple of times a week, and I can make what I need to make from the week from 10 minutes work. But you've got to be patient. You've got to wait for these things. You've got to wait for the right kind of move. And whatever, my statistics or what I've done over the years, that just seems to be the most statistically, kind of relevant trade that I have an edge. But I mean, it's just a constant, isn't it? It's a constant of looking at the market. It's a constant of knowing when the volatility is going to come, based around calendar events, based around technical levels, based around, certain types of movement. So all I'm trying to do is come to the market when I know something has happened and then trade accordingly, or come to the market before it happens and then trade accordingly. So I'm either fading what I see, as I say, or trading, the follow through of what's going to happen, then trying to apply a time framework around that, which encompasses my risk and my size. So as I say, I don't think retail traders should spend 10 hours in front of the screen every day, because you're going to see an opportunity to trade and you're going to get bored. You're going to do a test trade or you're going to do a boredom trade. When I sit in front of the screen, I'm trading and I keep my clip, purposely high. There is no kind of boredom trade. You put that trade on, you sat in front, you sat up in your seat, you're engaged, you're not playing around with size. It's not a game. That size is in the market. And I know once I put size in, I'm always going to average. There's going to be more. So, this is the thing, if you're there to make money and be in front of the screen and trade, there has to be a reason. If you sat there in front of your screens, for hours after hours, you will always find a reason. So what I've been able to do over the many years, what I've been doing is I still have screens on, I still have my accounts ready to trade, but I'm not sat there waiting for something. I think there's enough connectivity, enough information around there to be sat at times where the market's going to move, and we're going to see much more of this with Trump. That's what we saw, for the last 4 years when he was president. He would come out and say things, and the market would react in some ways, and it would quickly spike in one direction, then it would consolidate. It would come back, because he says a lot of things. It doesn't mean necessarily they're going to turn into something. So that might be an advantage, if you do have a Squawk service or you do have a Twitter feed up and you can watch things and watch the markets react. But then again, I find that is more the entertainment type trading. These are guys, that want, oh, I made 100 pips on that. Okay, so you made a few $100. So what? I want to be trading when I see something or hear something or I'm ready for something that I can commit to and use the size that I want to do. And again, that's all the book's really about is my journey, to size. And yeah, it didn't happen overnight. I went through my own trading journey just like everyone else. And yes, I'm not saying I'm the best trader. I've, got hit plenty of times in trading and had losses. And a lot of the times my biggest losses have been around data. My ego's kicked in and I've, thought this is what a market should do. And I've held the trade for longer than I should. It's like, well, it has to turn now. The market has to do it. I'm Steve Ruffley. I'm right. I understand this stuff. Then you get more pain. And then it's like, So, yeah, I mean, this is the thing. I've learned by making money and certainly learned by losing money. But, again, all I've done is condense this into a relatively simple framework of time and entry styles and, being able to understand that how much money and how much size I can put in at each one of those trades each time. So that's really how I got to where I am by that whole journey of the things I've seen, the things I've done, and yeah.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
In your book, you mentioned, quote, when the markets hit an extreme, it will always pull back. So how do we measure what is extreme, and kind of what are some technical indicators do you use to measure what is extreme or not?
Well, the extremes, again, will be based upon the range and that kind of stuff. Well, I like to measure extremes by previous movements. So as I said before, I'm a big fan of Fibonacci. So I'll use Fibonacci expansion points, to kind of view where I see the extremes of the market. So they can be very useful in the upside and the downside. So generally, that's what I'm looking for. But also, it's a very visual thing. When you see candles as they form and as they move, you start, I don't want to sound too Rain Man here, but you start to see patterns in how they move. And that's, again, when you're talking the professional side, you'll have professional software like CQG, you'll have market depth, have a lot of information that retail traders want. So my kind of extremes of the market, are based upon looking on, candlesticks and, on a retail platform. So there will be delays sometimes and there will be kind of jigs. So I have a set framework for every single product that I trade. My charts that I wrote, I had them written for me. It's my IP about 9-10 years ago. So my levels are already predetermined. So every single chart I have predetermined levels. So I know for me, what I think based upon my experience on mathematics and all the kind of, the technical analysis that I've kind of gathered that works for me. I know if a market hits certain extremes based upon my levels, that's what I'm classing as an extreme. It might not be the extreme to you, it might not be the extreme to the market as such, but the levels I've used and I have confidence in them. So this is the difference, when you're looking for somebody else to tell you, oh, that's a big daily level according to, this, analyst. So what? I'm not interested. I'm interested in my levels, in things that I've traded, thousands of times, and that gives me the confidence to trade to and from these levels. So everything's based upon my framework of what I've had written for me. And yeah, most of the time, it's fairly accurate, and sometimes it's wrong. But that's when the kind of, picking the kind of right trade type comes into play. I mean, there's lots of things when you trade at speed like I do in size. You have to make split seconds decisions, and that's part of the game. That's something you can't really teach. That's a combination of experience, as I say, the animalness, the aggressionness. If you want to be someone like me that does what I do, then it isn't. If you don't do something outside of the box, then you're just going to end up like everybody else. And the stats on retail traders is probably 70 to 80% of retail traders lose money when trading. So if you want to be something else, maybe you have to be doing something else. I'm never saying go to my extreme or do what I try and do and what I do, but you have to do something maybe at least slightly different, because otherwise you're going to end up with the same results.
So to wrap things up, is there anything that you've been working on that's exciting for you?
What, more exciting than the book that I took 3 years writing?
Oh, okay.
Yeah, I mean,
what is the name of your book?
Well, the book that I wrote was the Pro Retail Trader. That's just been kind of released in November of last year, so that's still pretty new. So I spent a lot of time writing that. As for new stuff, to be honest, I've done thousands of webinars over the years. I'm probably just going to kind of take a step back for a minute. I'm just going to, trade what I do, trade my size. And I don't know there's anything trading wise that's going to be particularly interesting. I mean, people always ask me to kind of, start up webinars again and, kind of live trade rooms. If there's enough interest in that stuff, I will do it. But the thing is, everyone's trying to copy what someone else is trying to do. That's what I say. And everyone's trying to kind of, watch what someone else is do. But the fact of the matter is, from all my years of being in the markets and the different types of traders and environments I've been in, it will come down to this, that those who can do it have it in them or can create that in them. If you can't, you're just going to be finding more and more reasons to prove that you can't do it. So maybe I'll try and do an expansion on that, maybe an add-on to the book or something. I don't know. But I mean, just for me, really, it's been interesting to do a podcast again. I've been working on the book. I've been quite quiet from a kind of ego perspective of kind of getting myself out there and talking to people. But it's been nice. It's been nice to kind of to chat to you guys. I've followed you for a long time, so it's quite nice to be on here, to be honest. Yeah.
Well, Steve, thanks for coming on Chat with Traders.
It's great. Thank you very much.
Yeah. How can our listeners reach you?
Well, Google, steveruffley.com, Twitter at Steve Ruffley, YouTube at Steve Ruffley, essentially at Steve Ruffley, everything's Steve Ruffley.
Great. Fantastic. Thanks for coming on.
Thank you.
Hey, stay tuned for my quick conversation behind the scenes with Steve after the interview.
There were a lot of golden nuggets there that I took for myself too. I'm an active trader, but
oh, really?
It's hard for me to become an animal because I try to like size up. I'm at the point where I am getting more consistent, and I do want to size up, but that is like psychologically so hard. And I did push myself, like what you said, I did incrementally sizing up a little bit, and it's just putting in the reps and just trying to do it. But it is so hard because it's just that my, I don't know, I just don't have that aggressiveness in trading, but I'm trying to push myself to be something I'm not.
I mean, no, I mean, you have to remember there's two things here. Okay. So the first time you kind of size up, you generally lose because that's just how life is. And, you have to bounce back from that. And the second thing is, you don't necessarily have to be a different person or an animal. I've had clients in the past that put on personas. So I've had, quite successful people, surgeons and that kind of stuff. And when they speak to me, they make them call me a different name. So they're not the surgeon person anymore. They're a different alter ego. I'm not saying go to that extreme. But as I say, when I do my kind of animal thing, and it's funny because I didn't even know I'd written that way. When you brought it up, it is. I'm only battling with myself, and I go into a state, and I'm hyper focused. I'm aggressive. I'm a little bit frightened. There's some fear and greed in there, but I'm not letting the fear and greed get to me. I'm using it to my advantage. I'm saying I've been here before. I've done this size before. It's trying to test you. It's trying to push you, and it will. Your averages are there. You've done it for long enough. It will come back to you. So it's just constantly pushing yourself and knowing that if it's in you, you can draw it out from yourself. It is in, I do believe that level of it is in everybody. It's just how hard you want to push inside and how you want to ask the difficult questions of yourself.
Yeah.
Mm-hmm.
That is awesome to hear.
Great.
Yeah, another thing too, I have one more minute, but I just want another golden nugget for me was the P&L thing. I hear people say, don't look at your P&L. And you said, oh yeah, I mean, you do. And I'm glad that you said that because I do. And I thought I was being crazy, but I'm like, I need to see what's going on.
Of course you do. Of course you do. And the thing is, that's for an investing thing. You don't look at your P&L because you've got your stop and you take profit. That's fine. You can walk away. I don't walk away. I'm looking at my screen there and then. And you have to remember that your P&L is your P&L. I trade big enough size. I'm not going to move the market, but I can shift the broker's book. So if some other orders or some of the trades come in, my profit, there was 10 grand in profit, could be switched to 1 grand in profit in an instant. So I'm looking, I've got a big close all button, and I'm watching for patterns in the P&L, how it jumps. And when it comes right, you see a big jump, especially with my size, kicks in for my average scalps, and then bang, I'm taking it. Because that second's hesitation, something could be there 1 second, and then it's gone. So when you're short-term trading or trading retail, you have to look at your P&L. It's imperative.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
One of the things that we see among very successful traders is a love for generating ideas, for studying markets, identifying opportunities in markets, digging, seeing things that other people don't see. It's all related to creativity. It's all related to research. But really, really good traders are motivated by idea generation. They're not simply motivated by P&L. When opportunities are not forthcoming in the market, they're able to be patient and not overtrade because they're so absorbed in researching and generating the new set of ideas.
Markets, speculation, and risk. This is the Chat with Traders podcast.
Hey traders, investors, and explorers of trading, welcome to Chat with Traders. As always, we're so glad to have you join us. This is Tessa, my co-host is Ian, and we're in episode 296. So how do you feel about trading psychology? Think about this. Across our 296 episodes, the topic of trading psychology, or aspects of it, shows up in about 242 of the 296 episodes. That's 82% of all of our episodes. The trading community has long held that success in the markets is about 80% psychological. When I look at those numbers side by side,
our 82% coverage and the often quoted 80% rule, you start to see a pattern. So, coincidence? I'm not sure. I don't think so. While some traders dismiss the psychological aspects of trading as nonsense and others wrestle with it daily, the data tells a compelling story. Maybe we keep coming back to psychology because it's impossible to ignore in trading. And guess what? In our interview today, Ian chats with a very prominent psychologist that you may already heard of. His name's Dr. Brett Steenbarger. And we're thrilled to have Dr. Steenbarger return to the podcast after 8 years. He was first featured in episode 65, which was a very wildly popular episode. And by the way, I would like to reference several other useful episodes dedicated to the topic of trading psychology. They're episodes 65, 86, 199, 200, 252, and of course today's 296. Some of them are oldies but goodies, and if you ever need help in searching for a certain trading topic across our collection of episodes to listen to, feel free to reach out on our website, chatwithtraders.com, and we're happy to help. So back to what I was saying about our guest. Dr. Steenbarger is a psychologist and performance coach for professional traders and hedge fund portfolio managers. You may also be familiar with his work with traders and giving really awesome presentations at SMB Capital. Much has been going on with Dr. Steenbarger over the years, including some of his views that have evolved over the years as he's worked with many traders. What are those views on trading psychology or trading in general that has changed for him? What's cool about Dr. Steenbarger is that he's also an active trader, so he gets us, you know? He's also published numerous articles and books on trading psychology, and we also get a sneak peek on topics discussed in his new book called Positive Trading Psychology, set to release sometime later this year. Oh, and by the way, we started adding a bonus clip section at the end of the interview for a behind-the-scenes conversation for some episodes, so if you make it to the end, you might get a bit more extra listening time. Hope you like this new format. Well, without further ado, let's dive into this great conversation. Ladies and gentlemen, we're so pleased to welcome back Dr. Brett Steenbarger.
Well, Brett, I would like to welcome you back to Chat with Traders.
Oh, thank you very much, Ian. I appreciate the interest.
Yeah, well, it's been over 8 years since you were last on with us. What have you been working on since we last chatted with you?
Wow, 8 years. Been doing quite a bit in different areas. I still teach at a medical school in Syracuse, New York, and teach short-term approaches to changing our emotions, changing our behaviors, and a lot of that is what I apply to my work with traders, with portfolio managers. So I continue to do that. And I've written a new book, and that will be coming out later this year. It's called Positive Trading Psychology, and it's looking at improving our trading by building on our strengths, not just working on weaknesses.
So, yeah, go into a little bit more about that. Some people say that you should be aware of your weaknesses so you can improve them, because who wants to have weaknesses, right? But you're focusing on more on just the strengths?
Well, focusing primarily on strengths, and that is a way to address weaknesses. If we focus on our weaknesses, we reinforce the concept that we're weak. And what happens in positive psychology is that you look at problems as being the result of not playing to our strengths, not making full use of what we're good at. So the idea is to study and study and study our successes, our wins, what we do well in trading, and then figure out, okay, how did I do that? What am I really good at? And build on those strengths. And sure enough, that takes care of many of the weaknesses.
For, say, some newer traders or people just getting into the field, Are there any ways that they can know about potential strengths that they have prior to getting a bunch of experience trading so they know where to focus on?
Yeah, clearly you couldn't know your strengths prior to that experience. So it's like someone just starting to get involved in sports. How can you figure out what you're good at? Well, you have to try basketball, you have to try baseball, you have to try soccer, what have you. You play different sports, you play different positions in different sports, and you see what you do well, you see what speaks to you. So there's a whole process of exploration that precedes specialization. One of the big problems that beginning traders have is that before they do that exploration, they trade. They put money at risk. They don't really know what they're good at. And predictably, they become frustrated and they lose money.
Some say that human psychology hasn't changed in thousands of years. Did you learn nearly everything about this subject before your first book that you wrote over 20 years ago?
Oh, wow, that's a really good question, Ian. Prior to my first book, which came out early in the 2000 period, 2003, I had been teaching for many years at the medical school in Syracuse and teaching these very topics. So my career as a psychologist taught me a lot about working with people, taught me a lot about positive psychology, and I ended up applying that to traders and trading. You need to learn. I keep learning. I read new things. I learn from the people I work with, and that's what keeps it fresh. That's what keeps it exciting.
In a previous interview, you mentioned you said that, quote, many traders don't really know what they do best. They are invisible to themselves. Why is that? I mean, why are traders invisible to themselves, and how do they get to know what they do best?
Yeah, because they're not focused on learning markets. They're not focused on discovering what they do best. They want to trade and make money, period. Well, let's say, as an analogy, that I go about meeting people for romantic purposes, and I'm focused on just making a connection and getting them into bed. And then I wonder why I don't have a fulfilling relationship life. To have a fulfilling relationship life, you have to explore relationships. You have to see who you get along with, who you don't get along with, where the chemistry is. And it's out of that that you develop something long term. When traders short circuit that development process, that leads to frustration, that leads to losses. But the frustration and the losses are not the problem. I mean, to say that if you work on your frustration, if you stop going on tilt, you're going to do fine. I mean, that's pretty close to insane.
Mm-hmm.
They need to learn what they're doing. They need to explore all the different types of trading, time frames, styles of trading, see what they're good at, and then build upon those strengths.
On the topic of self-coaching, which you have mentioned in the past, and continuous improvement, many traders struggle with self-deception when reviewing their own performance. How can traders develop an objective self-coaching framework that prevents confirmation bias and excuses?
Yeah, that is a risk. The coaching framework that I often talk about in my writing is just to review each day one thing that I did really well that I want to build upon tomorrow, and one thing I could have done better that I want to improve tomorrow, and a specific plan for improving that. So you're really looking at, well, I'll give you a perfect example just for my recent trading. I trade as well as a coach.
Mm-hmm.
So I found an opportunity. It was going short in the S&P, which has been weak last 2-3 days, and timed it really well and exited too soon. Okay, well, I did something right and I did something not so right. And so that becomes my review. And out of that review, I have specific goals and plans for working on those. How can I do what I did right today? How can I make sure I do it tomorrow? But how can I improve what I didn't do well and take it to the next day? So it's looking at what you're doing concretely, specifically, identifying what's working, not working, which you know objectively from your P&L, and then creating a process of improvement on that basis.
Would you mind sharing with us kind of what you felt you did good and what you felt you need to improve in the last few days regarding the recent drop in the market?
Yeah. What I did well, and I have a blog post, my Trader Feed blog alludes to this. I had the patience to wait for different time frames to line up. So the first thing I did right was not trade. I just waited and waited and waited for the time frames to line up. And what we had were overbought signals on multiple time frames where the market could not make a new high. And so once that started to turn over, I was quick to sell and take advantage of that. That's what I did well. In a sense, it was waiting for everything to line up for the trade to come to me rather than for me to try to make it happen. With the exit, I made the reverse mistake. So it went down quite a bit. It was oversold and not quite oversold or really oversold on the larger time frame. And I was premature in getting out. I was too eager to take the profits. And I know what I was telling myself at the time, but that was a mistake. And so I was patient on the entry, need to be more patient on the exit.
Great. Thanks for sharing. You've worked with traders, from my understanding, coached them across different types of asset classes and timeframes. Have you observed psychological traits or mental models that consistently separate the elite traders from the merely competent? And if so, what are they?
Yeah, and I've actually been involved in research at several different hedge funds to identify predictors of success. And there are a few. One of the things that we see among very successful traders is a love for generating ideas, a love for studying markets, identifying opportunities in markets, digging, seeing things that other people don't see. It's all related to creativity. It's all related to research. But really, really good traders are motivated by idea generation. They're not simply motivated by P&L. And so when opportunities are not forthcoming in the market, they're able to be patient and not overtrade because they're so absorbed in researching and generating the new set of ideas.
Can you give us an example of an idea that you heard from a trader that you found interesting?
Yes. It's a type of idea. The trader, and this is actually a team at a hedge fund, they noticed that certain things were going on in the currency markets, in FX, certain things were going on in the interest rate markets, and certain things were going on in specific sectors in the stock market. And they identified that there's a theme, a single theme uniting all of those. And that very large market participants, that would be groups like asset managers, were investing their money based on this theme. And so by identifying the themes that these big asset managers were following, they were able to be more nimble and get ahead of the anticipated moves. What they don't do is just look at a chart and look at a shape on a chart and decide to buy or sell. Like no one does. Literally, no one does that.
Interesting. So the traders that you've worked with, primarily institutional traders, is that correct?
Yes. I work with one proprietary trading firm, and I work with all the rest are multi-strategy hedge funds.
So the traders that you've worked with, they're not purely a technical trader.
They may look at technical factors, but that's one among many things that they look at. They would never put money at risk based on the shape of a chart. Now, they might say that for this and this and this reason, I want to be long. I'm seeing that, I'll talk about the current market. I see that defensive stocks are behaving better than growth stocks. And people are shifting money away from growth and toward value. And that is showing up on the chart in this and this way. And in fact, with the growth stocks like the NASDAQ 100, I can see we're breaking a trend line. And that becomes a meaningful idea. So I'm looking at the chart, but putting it into a broader market context.
In previous interviews, you've mentioned about using structured feedback loops to refine trading strategies and decision making. What is a structured feedback loop, and how do we create one?
Journaling is one structure that we can use to constantly get feedback about our performance. And what I just described earlier is a very simple form of journaling, just writing down the one thing I did well and writing down the one thing I could have done better. But you are creating a structure for regular feedback about your performance. And if you look at how people are coached in professional sports, for example, they have a coach working with them, observing them in real time and giving them ongoing real feedback. It's a structured process so that they can make continuous efforts at improvement. That's called deliberate practice. And it's really the foundation of improving performance.
Sounds like you're a fan for traders getting a mentor.
I'm hesitating because that's not so available to many traders. Now, at the places where I work, everyone has a mentor. People belong to teams. The more senior members of the team mentor the more junior members of the team. So that is a hallmark of the places where I work. And if you think about performance fields in general, performing arts, athletics, there's always teaching and mentoring. People don't learn on their own. I'm going to become a professional basketball player, and so I'm going to go out and shoot baskets outside and on my own. And that doesn't happen. So it's very difficult. It's challenging for individual traders to find that kind of mentoring, which is why it can make a lot of sense to have some initial success and then join a trading firm that can move you from there.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So in your early trading, did you trade for a while without a mentor? And did you at some point get a mentor? And what were the
Yeah,
results
good
with
question. Yeah, so what happened when I first learned trading, and I started trading in the late 1970s, every single day I printed out multiple charts of all the variables I was interested in. And then I would study patterns on those charts. So, for example, I would have a chart, like a 1 minute chart for the day of the S&P, and I would have a 1 minute chart of advances declines, a 1 minute chart of upticks versus downticks in the market. And I would look for patterns day after day after day after day after day. That was me mentoring myself. It was just intensive study.
that?
And to this day, I make use of some of those patterns. Now, later on, I started working for professional trading firms and learned a lot from the people I met with. And that was a kind of mentoring as well. But I've never full-time worked at a trading firm where I had a formal mentor.
Great. Let's go on to the topic of emotional resilience and adaptability. Traders often hear about the importance of emotional regulation, but is there ever a case where controlled aggression or frustration can be beneficial in trading? And if so, how would it be managed?
Yeah, good question. So I'll back up and just challenge the premise a bit. I had a teacher many years ago named Ayn Rand who would challenge premises. The most important thing in trading psychology is not emotions, period. Um, People have negative emotional reactions because they do things that they're not prepared for. They don't go about learning the right way. And so emotions are the result of the main problem. They're not the main problem themselves. Now, that being said, what is most important, especially for active traders, is focus of really being zoomed in on what's going on in markets, what's going on in different markets, how is it all related, and as I mentioned before, letting patterns, letting ideas come to you. Now, in terms of making the most of those patterns, yes, I think there can be a role for controlled aggression, for being aggressive, for being assertive in taking proper advantage of an edge that we perceive. So it's not that we're trading like robots, completely emotion free.
In extreme volatility, emotional discipline can be the difference between survival and ruin. What psychological techniques do you recommend for traders to maintain clarity and adaptability in fast-moving, chaotic markets?
Yeah. So in fast moving, chaotic markets, those are typically markets that traders have not had a lot of experience with. And the patterns that show up in those markets are quite different than the ones in lower volatility markets. So if you have a very low volatility market, particularly in the stock market, you'll see a lot of range bound or cyclical action. When the VIX gets really high, typically that's happening in a bear market or a rebound from a bear market. So completely different patterns. What makes it difficult for the trader is that because of the greatly increased volatility, you have to completely adjust the sizing of your positions because everything can move so much more unit time. It's very, very important to practice trading volatile markets before putting money at risk in those. And one way to do that is to go to various historical markets and play them bar by bar on your screen and practice thinking through what's happening and how you would respond and so forth.
So, okay, moving on to the topic of cognitive biases and trading decision making. Recency bias and overfitting are common pitfalls for traders using historical data. How can traders balance learning from past patterns while ensuring they are not trading outdated strategies?
Yeah, good question. If the strategies are going to be outdated, it's because something fundamental in the market has changed. So the professional traders that I work with, they are always monitoring volatility of the market. They're always monitoring the correlation of their market to other things that are trading. And when they see that volatility and correlations are changing meaningfully, volume, for instance, in the stock market would be a good indication. That's correlated highly with volatility. When you see those change, your first thought is, look, this is a different market, and you want to step back from risk taking. So an example would be if you're a race car driver, and suddenly you see that a portion of the track is wet or icy, you immediately make an adjustment.
Would you characterize the market that we're in right now at the end of February 2025 as a market that's changing to a new regime? I mean, a new type of market that we've been in the past? Or do you think this is just a pause and a continuing bull market?
It's a really, really good question. I do believe we are in a corrective phase of what has been quite a bull market. And we are seeing rising volatility. And we are seeing a number of sectors of the stock market that are not making new highs, even though the averages are making new highs. So that's a pattern we've seen at bull market peaks. We saw it in the late 1990s going into early 2000. We saw it in 2007 going into 2008. Fewer and fewer stocks participate in strength, and that leads to subsequent weakness. I believe we're seeing that now.
So in trading, randomness plays a major role in short-term outcomes. What methods do you suggest for traders to distinguish between skill-based results and those driven by sheer luck?
Yeah. When you have a trading idea, you want to clearly identify what would tell you that idea is wrong. Because as you're pointing out, Ian, there's random movement moment to moment. But if to use my earlier example, if I see that the market has bounced higher on multiple timeframes and seems to be making a lower high, and now all of a sudden we see more sellers coming in, I may aggressively get short there, but I know I'm wrong if we make a relative new high. If suddenly a big flow comes in and or a news event occurs, we make a new high, that's telling me I'm wrong in that anticipation, and I have my stop level. So the stop is at a level that tells me objectively that my expectations are not being met, rather than being based on just short-term movement.
So do you set your stop level based on rather certain levels that that if they break that level, then you think that we're resuming in a bull trend rather than a fixed percentage?
Oh, definitely not a fixed percentage because the market volatility can change from day to day and week to week. I'm basing the stop on my idea, on the trade idea, and what will tell me that idea is wrong. And so if I think we have topped out, I usually don't want to try to buy the absolute high, sell the absolute high of a market that I think will fall, or buy the absolute low of a market that will rise. In technical terms, I love to sell the right shoulders of a head and shoulder pattern, or buy the right shoulder. And so we've seen the absolute low, and now you get, let's say you see the absolute low, you get selling, and we can't make a new low. They're selling. We can't make a new low. And then you see buyers starting to come in. I'll hit that. And the previous low, that's the stop. Because that tells me it's not a reverse head and shoulders.
So some traders struggle with adapting to changing market regimes, kind of what we were talking about. What habits or approaches have you found do the most adaptable traders use to stay ahead of evolving market conditions?
Many times we can identify market conditions by seeing how certain markets or parts of markets are trading with respect to one another. So, for example, I collect breadth information, how many stocks are making new highs, new lows on different time frames for every single stock in the NYSE universe. And I post some of this occasionally to the blog. If I see that there's lots of breadth strength in certain sectors, but weak breadth in other sectors, that tells me it's a rotational market. Money is not going into stocks or coming out of stocks systematically. Rather, money is shifting from one part of the economy to another part. And so that will help me frame my trade ideas for that day or for that week. Now, if all the sectors are strong or all the sectors are weak, that's called a trending market. And so I'll be looking for ideas that take maximum advantage of that trend. But I'm looking at different parts of the market to identify conditions, and I'm looking at how those change over time to see if those conditions are changing. With respect to the large institutional money managers that I work with, they are looking across many different markets. So they'll look at stock markets in different countries of the world. They'll look at how what's going on in stocks is related to what's going on in interest rates, for example. And they'll generate ideas on that basis, and they'll generate ideas based on changes in those relationships. That's known as macro investing.
With the rise of AI-driven trading and algorithms strategies, where do you see discretionary traders fitting into the future of the financial markets? What human cognitive advantages do you believe will remain irreplaceable?
Certainly there are I work with systematic traders, and there are certain things that they're able to do that individual traders just can't do because they can't process all that information. So there are systematic traders I've worked with who literally look at every single transaction in the market, every single trade. And where is this transaction occurring? And is it occurring on an uptick, a downtick? Is it occurring at the same price? And they're updating, and they're seeing very quick changes in patterns and exploiting those, maybe just to make a tick or two or three in the futures market. The individual who doesn't have that computing power and can't process those data really can't compete with that. Where the individual can compete is in stepping back with patterns that the institutions don't focus on, can't focus on, or markets that they typically don't focus on. So, for example, we see a lot of inefficiencies in the trading of small cap stocks, very, very small companies, because they're so small that the larger institutions can't participate in them. At the hedge fund I first worked at, the minimum portfolio size, the smallest size, 200 million. Well, if you're trading a micro cap stock, you can't just put hundreds of millions of dollars to work. The bid offer will go through the roof. So by focusing on the least efficient markets, individual traders can find edge.
Have you ever been tempted yourself to go into the small cap stock arena where it's less efficient?
In working with traders, yes. In my own trading, I haven't felt a need to do that because I have an approach that does make use of high frequency information or higher frequency information. And so far, I haven't found that edge going away.
So a solid trading process can include proper research, disciplined execution, and risk management. Does this process change with changing market conditions? And how much of a drawdown before you and other traders you've talked with would take before changing one's strategy?
I mean, my feeling, and I'll just speak for myself here, if I've done my research and really have a good idea and confidence in that idea, a lot of research backing it up, and the idea doesn't work, then my first hypothesis is I've missed something. Something is different. Something's going on that I was not able to account for. I have to figure it out before I start trading again. So the loss becomes information. And often I'll even say to myself in my head, that shouldn't have happened. Like, this was a good idea. Why didn't it work? And typically I'll identify something that I didn't account for. And I have to put that into my process. I have to now account for that before I go forward with trading. So I want to use losses as information. I want to learn from losses to improve what I'm doing going forward.
In the past, you've emphasized a process-driven approach over an outcome-focused mindset. But in an industry where capital allocation depends on performance, how can traders balance the need for consistent results with the patience required for process mastery?
Good question. And now you're really up my alley because I'm involved in capital allocation at places where I work. And so many places allocate capital not simply based on level of profits, though that's relevant. They are also looking at things like Sharpe ratio. How much are people winning with their trades compared to how much are they losing? How smooth is their profit curve? Because if someone has a very liquid strategy and a very high Sharpe, a nice smooth equity curve, they're not drawing down a lot at all, then you might just want to give them a lot of capital and let them do what they're doing. Again, as long as what they're doing is liquid. So you're not really just focusing on absolute returns. You're focusing on the quality of those returns. Now, the other thing, if you're a trading firm, is that, or working at a proprietary trading firm, you have to be concerned about the uniqueness of your returns. So if you're making a good amount of money doing the exact same thing as everyone else, why do they need to hire you? Why do they need to keep you? If everyone else is doing what you're doing, you could just reduce headcount and allocate more capital to the existing people. So you want to not only do things well and do things consistently, but do things uniquely. The really good traders I work with are, to some degree, playing the game better than others, but to some degree, they're playing a different game. They're doing something unique. And that's how I identify talent when I help hedge funds hire.
Could you go into a little bit more about unique, like give an example of what you've seen would classify as a unique approach?
Yes. Let's see if I can think of a really good example. Okay. So a person who I work with who heads up a team talks to many different informed people during the course of the day and tracks what they're thinking, what research they've read, the people they've talked to, and he shares with them what he's been thinking, what he's been researching, and so forth. Across many different people that he talks with, he can see patterns and he can see when informed people are doing something different from what the majority are doing. And that helps him frame a trading idea.
Interesting. In the past, you've mentioned about using personality assessments to identify whether a trader is better suited for scalping, swing trading, or long-term investing. Can you share with us a few examples of questions that are asked in these types of assessments?
Yeah, and when it comes to scalping versus longer time frame trading or investing, it's not just personality, but cognitive style, how people process information that ends up being important. So, for example, there are some people who are very, very, very good at quick thinking, pattern recognition. Daniel Kahneman has written a book, Thinking Fast and Slow. These are fast thinkers. There are other people who are very good at deeper, more analytical thinking. That's the slower mode. And so they become good investors. The pattern recognizers become good short-term traders. At the firm I first started working at many years ago, the average holding time of a trade was 6 minutes. Yeah.
Wow.
Yeah, they weren't
Very short.
doing deep analyses. There's no time to do deep analyses. And so they were recognizing patterns in order flow. That's an extremely different game than someone who is looking at macroeconomic data across countries, across different industries, and putting those together, figuring out patterns of strength and weakness, and making investment decisions based on those.
As someone who spent decades in both trading and psychology, what personal beliefs about markets, traders, or coaching have you changed your mind about over the years?
Wow, what have I changed my mind about? I've probably changed my mind about the importance of the role of emotions in trading. I think I understand trading a lot better than I used to. Just as a, just as a result of working with so many people who are successful, and also my own experience. And controlling emotions is necessary, but not sufficient. The analogy I sometimes use is becoming a surgeon. You know, I teach in a medical school, and there they have to learn detailed surgical techniques, and they have to practice those again and again, and they're observed doing that. They get feedback doing that, and that's how they develop confidence. So, for example, a surgeon who's gone through the right learning process, how often do they go on tilt with their patients during surgery? Never. Now, I would argue that surgery is higher risk reward than trading. And yet those emotional issues literally don't occur in the way that they occur for traders. That's because the learning process has been structured in a way to create familiarity, experience, and ground people in rules, best practice rules about what to do. If traders can do the same thing, emotions are much, much less of an issue for traders. When I work at hedge funds, the number of people who will meet with me during a day, let's say I'm working across the day with multiple teams and multiple people, the number of people who will want to talk to me about things like going on tilt or, you know, the stuff we hear about losing discipline. Zero. None. No one talks about that. No one talks about that. So that's what I've learned is that if you learn the right way, if you have the right team structure, you learn within a team, you get the right mentoring, you learn to do the right things, it becomes second nature to you. And that really puts the emotions into perspective.
In a previous interview, you mentioned, you said, quote, pursue your anxiety because that is where your growth lies. We can be anxious about many things. How can we know which anxiety is worth pursuing?
When we think about our goals, when we think about how we would like to develop, sometimes those thoughts can become scary. And the goals can seem like they're a little too big. I'm afraid I won't make it, that kind of thing. But it's not a fear, it's not an anxiety out of danger. It's an anxiety that stems from questioning ourselves. But as I've also mentioned, great things never come from within our comfort zones. And so by definition, when we get outside our comfort zone, there's going to be a little anxiety. There's going to be a little uncertainty. But uncertainty over goals that we want to pursue that are meaningful to us, that's worth pursuing. So I'll give a quick example. Many years ago, over 40 years ago, I was dating a woman and I decided that I was going to ask for her hand in marriage. It's a sentimental occasion because we were at the top of the World Trade Center in New York City. Yeah. So we were at the top of the World Trade Center, and I'm ready to pose the question. I have a ring in my pocket. What do? I excuse myself and I go to the restroom. And I look at myself in the mirror, and I literally, this is what happened. And I say to myself, are you sure you want to do this? Are you ready for this? It was like gut check. Because at the same time, it was a big goal, a big development. There's some anxiety there. But it was the anxiety from coming out of a comfort zone, doing something new that I had never done before. And I looked in the mirror and I said, yes. So I posed the question. And over 40 years later, we're still together. So I guess I made a good decision. That was a trade. That was an investment. And yeah. But that's a good example of pursuing anxiety. It's anxiety from stretching oneself.
Sounds like you're saying to be selective on which anxiety we pursue, or the anxiety that's related to something of substance that has a meaning, because we can have endless anxieties about many things, right?
So a good example would be we've been successful trading, and now it's time to bump up our size. So when we bump up our size, the volatility of our P&L is going to increase, and that could make people anxious. So we have to be prepared for that. That's getting past our comfort zone.
Excuse the last interruption here. This is Tessa. We hope you're enjoying this episode so far. If you love the podcast, please give Chat with Traders the best review you can on whatever platform you're listening from. This will help us to keep the episodes coming. Also, if you haven't subscribed to our email list, please hop on to chatwithtraders.com and click on subscribe so we can keep you posted of information that may be of importance. Thank you. Now back to the chat with our guest.
So tell us about your new book called Positive Trading Psychology. Supposed to be coming out.
It'll be coming out this year. Harriman House is the publisher, and it's about the application of what's called positive psychology to trading practice. So in positive psychology, we're focused on strengths. We're working on challenges by learning about our strengths and building on those. And so, for instance, in solution focused work, a trader will come to me and say, I'm having these problems and I need to work on this and this. And I might say to them, tell me about times when you don't have those problems. Tell me about when your trading has been really focused, when your trading has not been impulsive, when your trading has not been overly emotional. Tell me about when you've done good trading. And let's figure out what's gone into that. So immediately we turn the tables and we talk about successes, successes, successes. And from those, we generate best practices, what this person does really well. And we work on ways of building on those best practices and becoming more consistent with those. That would be a good example of positive psychology. There is positive psychology applied to teams and to teamwork, where you can identify your best practices in teaching others and learning from others and functioning effectively within a team. So I cover all of that.
How often have you found that being in the flow state how important is that to generating positive returns in the market or being on your game?
Great question. I'll speak personally. For me personally, it's probably, if not the number one predictor, very close. If I'm not in that flow state where I'm so absorbed in the market that ideas and patterns are coming to me, then I don't see things nearly as clearly. I don't trade nearly as effectively. So immersing myself in different time frames, different markets, seeing what's happening, seeing the patterns that are showing up, letting it come to me. And at some point, it's like a light bulb goes on. Like, this is what's happening. Those are always my best trades.
And is there a way that we can measure whether we're in a flow state or not? Because is it subjective?
Yeah, there is a subjective element to it. And what people talk about with respect to the flow state and creativity, Mihai Csikszentmihalyi has done a lot of the research in this area, is that we're so absorbed that we aren't really focusing on, should I trade this? Should I trade this? You're not focused on outcomes. Time can pass by without you even noticing it because you're just so absorbed in what's happening. An example might be if you're just really, really into the music on a dance floor, and you're in the flow of it. That's a very different state. And you learn to recognize that flow state, and that helps you get back into it more often.
What has been the most challenging parts for you of being a psychologist for traders?
Wow. The most challenging parts, I would say the evolution of the industry toward larger and larger and larger teams. And working, some teams I work with, 15, 20 people. So it's like a miniature trading firm. The challenge of working with large teams where members of the team are interacting with each other, they're helping each other, they're learning with each other, from each other. They might be supervising more junior people. It really is like coaching a business. And that has been an evolution for me.
Mm-hmm. Great. Well, thanks for sharing. Well, Brett, I'd like to thank you for coming on Chat with Traders.
Well, thank you for having me, Ian. I appreciate it and look forward to staying in touch.
Yeah. Well, how can our listeners reach you?
Well, the blog is called Trader Feed, TraderFeed. And I've been posting, I think, since 2006. So there are a lot of blog posts. And in fact, if you're interested in the topic, you can simply go to Google and type in the topic and then Trader Feed, and articles on that topic will show up. I do have other books that are out, including a self-help manual of trading psychology called The Daily Trading Coach. And all those are reviewed on Amazon and sold on Amazon. And so people can find that under my name.
Fantastic. Thanks for coming on the show.
Thank you.
Hey, for those who made it all the way to the end, thank you so much. Here's an extra 5 minutes bonus clip of my own behind the scenes chat with Dr. Steenberger. I started trading about 10 years ago, on and off, but it was only last year that I went all in on my trading, being laser focused on trading and taking it seriously. But I find that I know that my psychology and mindset, affects my trading, but I'm also convinced that the type of style of trading that I chose to do affects my psychology. It's like the other way around. It makes me feel like an idiot sometimes. So it tells me that maybe it's more important to choose the right kind of trading that suits your personality. And then the psychology of trading might be less of an issue. But that's just, what I'm finding, what I'm going through.
I couldn't agree more. And that's what I was referring to with Ian with respect to cognitive style. Some of us are big picture thinkers. Some of us are very quick thinkers. And if we try to process market information in a style that is not our strength cognitively, then we create frustration, we create overload. And so it's very important to figure out what style, what type of market, what style of trading. I personally do not do well in very fast moving, volatile market conditions.
Mm.
And that would just overwhelm me and make me feel anxious.
Yeah.
I also don't do well with very long holding periods, which more like active investing. So I've learned through experience what time frames work for me and what style of trading, what markets work for me. But that's taken some experience. But your point is very well made. Being in the wrong type of trading for you itself can create emotional challenges. So it's not that working on the emotions is going to help your trading. It's that you're playing the wrong game.
Right.
If you're in a sport that isn't really what your body is good at.
But you don't know that until you try all kinds of things. Like in trading,
Exactly.
I didn't know that until I tried scalping, day trading. And then in the end, I find, you know what, I'm going back to my options trading, which is just the right. I mean, you mentioned creativity. I love options because it allows me to be creative because I'm naturally more of a right brain person. And so I find that options trading is just the right level of challenge. And I still have to deal with the emotional part of trading. And I think the psychology part of it is less of an issue. And it's more about putting in the reps and gaining the experience and honing your strategy, kind of the processes and, and treating it like a business. That's kind of like where I'm at right now. Yeah. I have one more question though. It's still related to emotions though. When you're in the moment, like in the trading moment, and what is your method to manage those emotions when you're starting to feel that kind of like, you're going to do something like stupid, but you can't stop it because of your emotions? I mean, how do you manage those emotions like in the moment while you're trading?
I don't have those emotions. It's like asking me, I work with people in psychotherapy. I'm a psychologist, and people will come to me with their personal issues. It's like asking me, well, how do you manage your emotions while you're talking to these people? Well, I'm so focused on the person. I'm not thinking about, oh, is this therapy going to work out or is it not going to work out or will it work out quickly? No, I don't think about it. Again, that analogy I used with a surgeon, you're so focused on the process of what you're doing and the steps of what you're doing that it's not about the P&L. Now, one thing I found very helpful is when people are learning trading, if they are already financially secure, then they don't have to worry about losing on this trade or how much money I'm going to make.
Pressure. They don't have that kind of pressure.
No, it's very helpful to not have that pressure. And when I have seen people have those emotions that intrude, it's because they're not just wanting to make money or planning to make money, they're needing to make money. And that creates a lot of the emotional pressure.
If I may ask one more thing, because you mentioned a lot about like you notice the successful traders are ones that I think you mentioned they work in a team structure, they're team structure based. But the truth is, I think a lot of traders are retail traders. I think there are more retail traders than there are like proprietary traders right now or institutional traders. And so naturally, there are people who go into trading like myself. I consider myself a retail trader. Are naturally more like, I guess, entrepreneurial, or they want to do things independently. They don't maybe don't like to work in teams like myself. I like doing everything by myself. So do you think there's hope for the rest of us that don't work that way, trade that way? And
Well, I think you can work collaboratively with other traders without having a boss and that kind of formal structure. And I think that's why many people are joining trading communities, because they want an environment where they can communicate with other traders, learn with and from other traders, but still maintain their autonomy. So for them, I think that can work out very well and have many of the advantages of teamwork while still preserving the independence.
right, good point. Community is extremely important, and yeah, thank God that there are a lot of trading communities out there that we can access.
Yeah, and there are some good ones. The other thing that I've mentioned before, by the way, this is Mia Bella.
Oh,
Mia
cute.
Bella is a Russian blue cat.
Oh,
Is a good friend, but it really, 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 really helps to have lots and lots of things in your life that are more important than trading.
absolutely.
Yeah, and me is one of them. Uh, and we have 3 other cats, and my wife and I have 5 children, and we have 7 grandchildren, and we have 4 cats.
Wow.
And I have a career as a psychologist and teaching in a medical school, and et cetera, et cetera.
Trading and trading. How do you do it all?
Who's on a trade? I mean, seriously, big effing deal. I mean, really, is that going to define who I am and what I achieve? And, it's something I'm into. It's something that I work at. It's something I enjoy. But it really helps to pursue something when you don't need it with a capital N. And by having a well-diversified life, it takes so much of the pressure off each individual trade.
Yeah, that is so true.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Trading in the financial markets involves a risk of loss. Podcast episodes and other content produced by Chat with Traders are for informational or educational purposes only and do not constitute trading or investment recommendations or advice.
If Delta is the holy grail, AI will take over our job already. Delta is just one thing that people like, if they just trade straight from Delta, they're very mechanical. It's like, Cody, I open trade today, I close tomorrow, I open trade today, I close today, whatever. But a lot of times they forget to look at, there's Black Swan event, there's Donald Trump event, there's FOMC event. There's a lot of variables out there that will screw those Delta, screw those 75% within the day, right? The moment you start getting closer to your stop price or your strike price, all of a sudden Delta is like, oh my God, like Cody, like it dropped really fast. And then when below is like, okay, Cody, now it's 1-to-1 now, like what's going on, right? So like, I don't think probability could be looked that way, but there's no formula you can calculate that. Black short is just a very rigid formula that kind of tells you, but that's not the real probability. That's why our team are always looking at how do we dodge some of the event. We're okay leaving a little bit of money on the table. We look at, for example, the Liberation Day. I was telling my team, Liberation Day, okay, more upside or downside? Everyone's like, downside. Exactly. So if we have bull put spread, can we close some of it? Only leave 25%. They're like, yeah, it kind of makes sense, because what's the chance that will go up? Is Donald Trump going to say, I have mercy for you guys, but he's like going to do something innovative that shock everyone anyway, right? So the chance of the upside will even staying still, it's so low. So we actually should have some bear call spread, more bearish position, not too much, more neutral and less bullish position. So that's the way we position it, right? We have a little bit of bias, just based on, not just based on technical, not based on just Delta, be like based on what Donald Trump is going to do and how people is going to think, react to it, right? So that's kind of like, how do you quantify that?
Markets, speculation, and risk. This is the Chat with Traders podcast.
Welcome to Chat with Traders. We're on episode 297. Oh, what a crazy market it's been, huh? I hope you're all doing okay out there in the markets, whatever your trading situation, protecting yourself and your psychology, your positions, and waiting patiently for the right opportunities to show up again. This is Tessa, your co-host, and I happen to also be a developing trader like some of you, working diligently every day on my trading. My trading journey has been rocky for a long time, but I have to say for the past year now, I have been intentionally learning, gaining experience from every trade so that I can accelerate my trading progress. What about you? How's your trading going overall? Are you happy with your progress? What do you think you're missing, and how can you make your trading simpler if possible? Those are the two exact questions I ask myself a lot now to help me focus and refine and improve my system and process. I just thought I'd share every so often with you a little bit from my trading journey, and hey, feel free to share yours. We may end up reading what you're willing to share on the podcast, just like they used to do back on the radio, remember? Well, for those of you who do remember. What do you think of that idea? Okay, hold that thought while I get us back to the main part of this episode with my co-host Ian Cox, who had the opportunity to chat with Cody Yee, a former engineer turned trader and investor and entrepreneur whose number one goal is always to preserve his capital first, and growing it would come second. Maybe this might not sound as thrilling as you might hope, but as you listen to his story and journey into impressive double-digit returns and how he describes his three main strategies, which he calls it his fast, medium, and slow money, diversifying in different strategies and timelines, allocating about a third for each strategy. The practicality of it all is actually quite remarkable, building his edge through teamwork, structure, clear rules, and consistency. His approach to the financial market is all about trading less, but earning more. Is that possible? How does he do it? Well, let's dive into the conversation now. Ladies and gentlemen, we're so pleased to introduce Cody Yee from our respected neighbor to the north, Toronto, Canada.
Well, Cody, what a day to have an interview. Markets in turmoil. VIX is spiking. Great time to do some options.
What opening, yeah. Like for people who's listening to this, Apple dropped 9%, since January 2025, it hasn't really dropped much. So we're definitely seeing a lot of opportunity. I have a lot of cash sitting on the side. So I have my target price set. And as some of the stocks did almost reach that point, so I have some limiting order to buy. But in terms of option, it's very tricky. Because this drop, since the height of all-time high of January, we haven't really seen any rebound, and that's usually, for the last 2 or 3 drop, like it's been kind of like this. Usually, you kind of drop and a rebound and it drop more, but last few times it's just pure drop, right? So it's kind of scary, definitely. And at the same time, my team and myself, we've seen different scenario, but every time is kind of different. So we just had a meeting yesterday for about an hour and say, hey, how do we, always learn from mistake and moving forward? But we don't really see a bottom yet, right? I would say the bottom will be when all the corporations come out and announce that, hey, recession is really here. And I think that'll be another 1 to 2 months. I don't have the crystal ball, but I'll hang tight and don't over trade, because who knows? It can drop to 5,200 S&P 500, really. Right? I don't hope it'll go there, but it's very unpredictable. So definitely tone down your account size and don't do crazy things at this time.
Well, fantastic, Cody. I'd like to welcome you to Chat with Traders.
Thank you.
Yeah, and before we dive into the turmoil going on in the markets, I'd love to dive into your background. Tell us a little bit about kind of where you grew up. What did you study in school? And
yeah, so I grew up in Taiwan. I'm a typical kid. The exception I will say I have is a little bit of athletic talent. So since I was a kid, I was playing a lot of sports. I have a lot of medals, trophies, all in sports. Nothing in music, nothing anything else. So, there's a saying in Chinese that you're very agile on your limbs, but you're not very developed on your brain, sort of saying. So I thought I was that person. So I'm very easygoing. Grew up in Taiwan, and at that time, my family's, my dad has a really good job, but he's not very good with finance. So I think growing up, I was inject a lot of scarcity mindset from my mom. Because there's a few calls where there's margin calls. Call my mom and my dad need multiple 6-figure USD in 15 minutes. So I think my mom was very shocked by it, and I think that really kind of planted the seeds in a lot of what I do. Try to have financial freedom, independence before I come to Canada at the age of 18. So yeah.
Mm-hmm. And so what was your family's attitude and cultural attitude towards taking risk and stock market in general?
I didn't have the best education.